Good morning, everybody. How's everyone doing? Can you hear me? Quick little audio check. Hey, morning, Dennis. How's it going? Lisa, Richard, Cliff, Curtis, good to see you. John, excellent. All good, yes. Okay, good morning, Christine, William. All right. So let's see here. Middle of the month, we're settling into brand new 2017. And market's kind of settling in. We've got, the what feels normal now, the normal chaos in the politics world. We've got kind of waffling up and down markets. Generally, from what I saw this morning, things looking a little bit on the negative side today in the markets. Let's see where they are right now. Before we get going too far, let's knock out the disclaimer. Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trade. All securities and orders discussed are tracked and monitored in virtual trading paper trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither Top Gun Options, TGO, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk, and options may not be suitable to all investors. Visit the OCC website at www.optionsclearing.com to read characteristics and risks of standardized options. TGO provides educational and training services that are meant to teach you the risks and potential rewards of trading options. We're not a service that tells you what to trade. We're not implying or guaranteeing any profit. As always, do not trade with money you can't afford to lose, and make all trades in the TGO program in a paper trading account. Past performance does not equate with future results, and results discussed in this webinar are not necessarily typical. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss or losses you may incur from the information discussed in the media identified above. And welcome to everybody. All righty. So what do we got? Well, hey, we are officially digging into earnings season. As a matter of fact, tomorrow we have, hold on here, let's get something a bit more interesting on the screen. Tomorrow morning, we have a whole slew of bank stocks coming through. Going to be interesting. We have some good possible trades. I've got three actual earnings trades that we're going to plug through today as possibilities. Got a handful of pre-earnings trades, and then a couple of other smattering of other trades floating around. But we get to get into a bunch of other stuff and some interesting trades today. Probably one of the more fun seasons for me. Volatility trading is all about fear, uncertainty, and doubt. And nothing generates more fear, uncertainty, and doubt than a nice earnings season. In fact, I'm jokingly, labeling this as my year. Fear, uncertainty, and doubt is one of those concepts in the trading world and especially the options trading world, which can drive a lot of changes and a lot of things up and down. Presents a lot of opportunity, a ton of opportunity to create some good, solid trades. If 2016 was the year of being angry and things like that, I'd say that 2017 is going to be our year of fear, uncertainty, and doubt. We could have a lot of trades being driven in this direction. So I guess we'll dig in and we'll see what we can find here. Hey, Andre, TP, Shane, Jim. Good morning, Jim. Hey, Jim, I saw your note. You got that stuff sorted out on the trade stuff you were dealing with on TPM. That's good. Let me know if there was anything else. Jim's one of my Wingman Group coaching members here too. So good to see you here this morning. Hey, Doug, actually, I see you there too. Excellent. Good. All right. So what do we have? What do we have going on? Well, let's see. Actually, probably ought to dig into. Actually, I wanted to see what the weekly jobs report was. This is funny. It's gotten to be less and less of a important thing looking at the weekly jobs number. you know, we've got employment that's actually pretty high. Let's characterize what's going on out there in employment. First of all, the participation rate in employment is bad. That's been a general trend for a very, very long time. It hasn't been just the last couple of years. It's been a long time. The participation rate is the number of people who are actually interested in jobs. The people who want to get a job and get paid out there. That number has been going down for a very long time, and it's at a pretty low point. That's a dangerous thing for the economy, by the way. We need people participating. We need people out there who want to work and have jobs, because the fewer people that we have with jobs, the less people that we can, tax, have paying into Social Security, have supporting Medicare, have doing all of these other things. As participation goes down, it's generally a bad trend. Now, the positive trend is that the people who do want jobs seem to be getting them, and the unemployment rate is at a substantially low rate. Haven't seen any major changes in that. It's been drifting down, which is good. Would love to see it get a little further down. Big number that I worry about the most is, the actually full-time equivalent jobs. They're getting, and the amount of pay. We need to get money out into the economy at the consumer level. One of the biggest things that's been dragging on our economy so far, this is a little different narrative than what you typically hear, is the demand side of the economy has been really, really weak. Most of the time you hear economic things from the supply side view. Do companies have enough money to finance expansion? Do they have enough money to hire new workers? Do they have enough money to do this, to do that, to grow, to build new markets, to research new products, to blah, 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 do everything they want? Well, at this point in time, companies have an ungodly amount of money to do those things, and the access to resources to do them, which is nuts. Cheaper access to money, lower cost loans. They have got more money in the bank on the books than they have pretty much ever had before. Interestingly enough, profitability on companies is up quite high, extremely high at this point, but they're not investing that money into growth. In fact, the majority of the money that's being turned over out there is what I personally consider a horribly bad use of money. Whenever they're borrowing money, they seem to be doing stock buybacks, which is interesting because it has a short-term effect on the stock price, and it has a long-term negative effect on the company value. So you've got a very odd situation where basically the corporate leaders are doing something to pump the stock price over the short term, but it doesn't help the value of the company over the long term. Flip around and take a look at it from a bigger business point of view, and you can realize that the supply side is not the part of the problem. We need more money in a broad, middle America, tax-based. We need people to have money in their hands so they go out and buy things, and they drive things from the demand side. And by the way, I'm not making anything of this up. It's a pretty known problem. It's a pretty well analyzed problem. We need to have more people buying things. Now, not that I necessarily want everyone to be a consumer-driven person, but economically, we need that money flowing around in the economy more to drive things up, to drive up GDP. We're seeing some of that, which is good. We want to see more and more of that. Average wages are going up a bit. Knock on wood, we'll see more of that. But we've got a long way to go before that's going to have a significant effect. if we want to get, the broad economy rolling, we want to get more people buying things, which means more money in their hands. Ideally, that's higher wages. Now, we have a bunch of other things floating around in the market and trying to drive things up and down. Let me see here. Wanted to check in real quick on where we're at overall. Hopefully what we're going to see over the next several months, over the next several quarters, is more of that growth and a little bit of GDP bump. Now we're coming into an earnings season right now. Walking in to the period of time when the companies get to tell us exactly how well they're doing and how much they expect to see out of the future. Great. Now, in general, this is looking to be a pretty positive earnings season. That would be a wonderful thing to see, especially from my point of view, if I see them putting money into growth and, allocating some of that cash and some of that available capital out there to growing their business and expanding. Now, that would have a good effect in a lot of ways. They're going to need to hire some more people to do that. They're going to be creating long-term value increase in the companies, and everything turns out better. The other thing that we are hopefully going to have a continuation of is last quarter was the second quarter in a row where we had a positive earnings season. Now before that we had a very tiny, barely positive one, but we'd gone through almost a year and a half of pure earnings recession. Companies had been basically reporting year over year decreases in earnings. Now we've pulled out of that. That's good. But we need more of it to basically bring the fundamentals up to the point where the market prices are. Market prices are still very, very high relative to the cash flow, relative to the earnings of the companies you're buying. When you get down to it, what you're buying every time you buy a share of stock, and I know we trade options, but it's all intrinsically linked to the stock shares. What you're buying is a share of the assets the company has and a share of the future earnings that that company has. When those earnings are very, very low and you're paying a very high price in stock, you've got this high multiple, you've got an overvaluation of the stock prices. And we had been in that for a long, long time. In fact, for a period, we were sitting up around the 90th percentile for valuation. Now, I know that everybody here has probably seen those reports that justify that valuation in some way. They use some kind of weird little esoteric approach to, well, if you don't count this and if you look at this a little different here, then this is perfectly normal. I'm calling BS on that. The stupidest words you ever hear in the market ever is, it's different this time. Well, the reality is it's not different. We're sitting on this precipice of ultra-high valuations versus terrible, versus lower cash flow, lower earnings. And that was causing a very dangerous position in the market. The nice thing is we're now slowly starting to reduce that problem. As earnings go up, and as long as the stocks don't shoot up too fast, what we have is we're getting back towards a little bit more normal valuations. And we're actually down off of what I'd consider the edge. But we have a long way to go. This earnings season should be a big part of that. So knock on wood, if the expectations for this earnings season come together and, we do actually have good earnings, we're going to see some of that problem going away and some of our risks will start to reduce. Doesn't mean they go away entirely, but be nice for valuations to get down towards a little bit more of an average level. At one point, we were at a point where we needed the market to drop 15% just to get down to an average P/E ratio across the market, just to get to average. We're slowly starting to whittle away that, which is good. Let's see if we can have some positive things this year. Love to see a nice, strong, consistent year with a little bit of craziness and volatility so we can make some money on our own. Let's see here. What do we got for... So people don't want to work. Who wants? This is normal. Actually, no. It's Want to work? Sure. I mean, I can certainly justify that there's a lot of people who don't want to work. The problem is the percentage of people who have no interest in getting a job is getting higher and higher. Now, I'm not saying it's shooting up. It's not. It's a gradual change over time. And here's the challenge that we have with that. Our entire system is predicated on the idea that we've got workers who are actively paying into the system in the form of taxes and things like that, and supporting what our country does. And I mean, that's everything that we talk about: our defense, our roads, our, everything. And as that number diminishes and goes down, that actually really hurts how everything works. Now, I'm not going to get into an argument one way or another about immigration and things like that, but there is an aspect of immigration that is very, very valuable for us. Now, ideally, what we'd like to have is nice, clean, legal immigration where everything's above the board and known and controlled and managed. But immigrants actually supply a nice, active portion of the workforce that does help out that, and replaces some of the people who are less interested in working. It actually is very helpful for helpful for the economy. Obviously, it carries with it lots of other issues that we're struggling with right now. So I'm not saying it's all a cut and dry issue, but there is a very positive aspect economically for immigration. Money velocity, Jim, yes, absolutely. Money velocity is a major issue right now. I don't even have a chart up for that, but what Jim's talking about is the speed at which money flows through the economy. And what we've had over the last, quite a while now, is a massive stagnation of money in the economy. It's not moving. By the way, big, huge misconceptions about what the heck money is. Money, the amount of total dollars floating around doesn't mean anything. It's the number of transactions that happen with those dollars that mean something. Money flow is the measure of how quickly a dollar bill flows through the economy and how many times it has a transaction effectively, how many times it has an influence on what's going on out in the world. Every time you make a purchase, it's kind of like a vote of how do we allocate resources in the world towards something. My dollar says we should do this, and I'm saying that by buying something. When we have less transactions, economically, everything slows down and it becomes more difficult to get things moving in the right direction. We need to kickstart that. None of these are, problems that we need that are unstoppable or impossible problems, but they're things that we need to see improvements on. And that'll help us economically, and that'll help us market-wise. Why am I saying this? Because we are in one of the longest bull runs in the market in history. If we're going to keep it going, we have to have some form of growth to support it. So all of these things are tied together. If we don't see some of these things, we're going to be in a higher and higher risk position all year. And who knows when, but we're going to have some pain out there. We need to be aware of that. Personally, as an assessment, a non-political, non-motivated assessment, I actually think that some of our risks in those areas are starting to go down. Whatever the reason it is, we do actually have some of those risks overall going down, which supports the fact that we may actually have, knock on wood, a moderately positive bullish year in the market. Now, this is the time when things usually sneak up on you and surprise you with something painful. So still be careful. But we are seeing some broad indications of maybe moderately good stuff. Let me see if I can be as vague as possible on that. But so over the next couple of weeks, we're going to see a lot of earnings announcements, a ton of them. In fact, let's see here. This is a little chart of upcoming earnings announcements that are what I would consider fairly significant earnings announcements. These are all companies that are in the Extended Weeklies Options Program in the CBOE. What you're seeing is the number of days before the earnings announcement and the count of the number of earnings on that day. This gives you a sense that in about starting next week, we're going to start to get a trickling of these in, and we're going to see more and more and more. It's going to start surging. We're going to see a lot of new earnings announcements coming up. All of these represent a very good opportunity for us. That's one of the things we're going to dive into today and actually play with a few trades for that. This is kind of a wave that's coming at us. Each day, this whole chart shifts a little bit left, and we get closer and closer to having more and more earnings. Two styles of trades that we're going to be dealing with. One is what happens to implied volatility as we approach an earnings announcement. And the second is what happens to implied volatility and price movement as we hit the earnings announcement and go past the earnings announcement. So we're going to touch on both of those today and hopefully have a chance to dig into some trades around that. Knock on wood, we have a fairly decent number of trades that are coming up actually today. Let me see here. We have Bank of America, we have JP Morgan, we have Wells Fargo, we have Morgan Stanley. Oh, no, not Morgan Stanley. The three major banks right there, those all offer us possibilities where we might be able to set up an earnings trade between today and tomorrow. Now, a little warning on these. The earnings trades I'm going to do rely on a high level of fear, uncertainty, and doubt around the earnings announcement. And regrettably, at least for us in this situation, those three symbols don't necessarily generate the huge amount of fear, uncertainty, and doubt as maybe other symbols do. So there's a chance we may not be able to dig out a good trade, but knock on wood, I think we've got a decent possibility of nailing one of those. So I guess we'll get rolling here in a second. Too much Social Security is a reason? I don't know. There's lots of things you can argue one way or another. Michael, multiplier has to be hugely impacted by foreign workers sending money back to Mexico. Absolutely not. An absolute trivial amount there. You want to know what the multiplier is that's being driven by right now? Absolutely huge amounts of cash sitting in the bank in large corporations. Now, that is the number one thing. And the other thing, to the tune of nearly $2 trillion, which dwarfs anything being sent back through the cash now store down the street, is the banks themselves not loaning out money. You want to find the number one culprit to the reduction in money flow? Banks. Absolutely, no doubt about it. By far the biggest driver of money flow dropping is banks themselves. And that shows up in the excess reserve accounts because those excess reserves are part of the money flow. And if you've got $2 trillion sitting, not doing anything, not being loaned, not being used, that's just on the bank side. And then many, many trillions of dollars on the corporate side doing the exact same thing, which is exactly what we have right now. Money flow gets completely stagnant. Remember, all of that money sitting in those locations, if it was not sitting there stagnant in the banks, would be paying suppliers, whose suppliers would be paying employees, would be paying truck drivers to move things around, would be paying for raw materials, would be paying for the person to get the raw materials, who's going to be paying at the grocery store, who's going to be doing all these things. The money supply or the money flow rate is being stagnated almost, there's certain other things, but don't fool yourself. I'm not going to let you fool yourself and think that it's the immigration people that are causing that problem. It's not even close. If that's a part of the problem, it's a thin, tiny sliver. Um, let's get investment from companies happening. Let's get them to use that money. That would be the biggest driver of economic growth right now, is getting that out of the banks, out of where they're saving that money and storing it, and actually turn it over and use it. So, and by the way, I could actually back that up with true, honest to goodness numbers. That's, I'm not going to sit here and make stuff up on that. I can even show you right now, $2 trillion sitting there not doing anything. All right, let's see what we can find. And by the way, I'm not trying to be politically motivated on that. I just want to actually face reality of what's going on. It is, it's wonderful to think about things in certain ways, but to fix things, we actually have to look at where the core problem is. And number one thing, you want to know the number one thing that would actually affect that right now is if the Fed changed one tiny little number, which is the interest rate on excess reserve accounts. All right. Right now, the Fed is paying banks 0.75% per year to not use that money. That was actually a federally mandated program. It said if we're going to do quantitative easing and put cash back in banks, then the Fed has to pay the banks for having extra cash. That number has been going up along with interest rates. And every time it goes up, it creates an additional incentive for banks not to use that money, which leaves the money stagnant there and not moving. So that right there would be the number one change. So I'm not sure how to do that, but call your local Fed governor and tell them what to do. Probably won't listen, but oh well. Bob, is this the new trade targets link? Okay, the spreadsheet you're seeing in front of you right now is what I have still been working on to try to get things going. But if I do this, you will notice that in a second, it's actually doing its job and updating. It actually ends up breaking in a second. And I have been beating my head against the wall trying to get all of this stuff tuned up and fixed up and get you guys a brand new version of an entirely new earnings tool, which will basically help us identify what's going on out in the markets. Right now, the best tool I've got for you to use that's not broken, and I just need time to debug this and get it all fixed up and working, is the older style spreadsheet that's still partially working. Now, let me tell you, I can give you a link to this spreadsheet. If anybody needs it, they can download it. But I'm going to flat out say this, there are problems in this spreadsheet. The place that I got data from to build the spreadsheet out changed a whole bunch of things. And I have fixed some of the problems, and it does generally work, but it also misses a ton of different symbols information because there's just these quirky little things going on with the place where I get the information from. Working through that problem, you're welcome to have the old version and the updated old version, which is as of the 5th of January. If you've got the 2017 1.5 version, then you have the most recent. That's the semi-working version. But it's still not 100% perfect. And that's what I'm pushing towards. Really hoping to have it out soon. But man, I've been slammed with a lot of work lately. So, and a lot of other stuff. So still fighting along there. Let's see. TP, is there a chart or graph of something to look at? Are you talking the banking situation? I can show it to you really quick. Let's see. Actually fairly easy. Excess reserves of depository institutions. Boom. This one right here. Yep, there we go. A non-made-up number. Current amount of money sitting in banks, not being used in the economy, not being loaned, not doing anything except making banks a ton of money with absolutely no effort. 1.925 billion no, excuse me, $1.925 trillion right there. And that is from the Federal Reserve. From the same people, if you want to take a look at, let's see. Hey, Jim, you might know this. Is it the M2 rate or the M1 rate that we're looking at? Money flow. Velocity of M2 money stock, I believe. Each of these is filtered in different ways. Yeah, there we go. Velocity of M2 money stock. This is basically a measure of how quickly money is moving through the economy and turning over. The faster and the higher the number this is right here, the more effect a single dollar has in the economy. It's hitting more hands, it's doing more things, it's creating more of a positive effect in the economy. And you'll notice, being stock people, that this is a trend, and it's a negative trend. It's not a good trend. And that is something that needs to get fixed, because that is going in by far the wrong direction. What's actually amazing is we have had GDP growth despite the fact that this is going down, which is kind of a very scary concept, because we're fighting a tide here. When this starts moving back up, by the way, that's going to have a major effect on how the economy is going. It'll affect a lot of people in a lot of really positive ways. Love to see that. All right, let's dig into some trades. Yeah. Yep, it is nuts, Jim. I agree. It is a collective form of insanity that we just seem to accept. I don't understand why, but hey, I'm not the guy to fix the problems. I just want to try to make sure that I personally have money in my pocket so that I can live in the future. We'll see what happens. Hey, Robin, did I put that question about my focus for the day on my opening screen? Actually, not to be somebody who pitches something, but all that is a little plug-in for Chrome. And it's a nice little screen. I love this thing. I'm not even sure. Hold on. Hold on. Forget where this is. Extensions. I think it's something called Momentum. You can download it if you want, but it's a cool little screen, and it just helps everything look nice. And yeah, it does have a little to-do list and a what's my focus for the day thing. I need something like that, by the way. Feels like I get pulled in about 50 different directions every day. Now, being a trader, that's not a bad thing. You're absorbing a lot of information and you're working with a lot of stuff. So you need to be looking at a lot of things. But trying to be focused and get things accomplished, like fixing bugs in spreadsheets so that I can hand them out to everybody, helps to have a motivation for the day. So I'll see if I can find that plugin. I'll add a little link to the recap today. Okay. Hey Juan, how's it going? Sign you up? Wow, that is an old reference, Juan. The Cars. Money for nothing. You're dating yourself. I'm probably dating myself, saying that I recognize where that comes from, too. Dire Straits, sorry about that. I was thinking Cars. Wow. See, 2 signs I'm getting old. I'm recognizing extremely old cultural references, and I'm forgetting where they come from. I'm going to be my dad soon. Except he was more Beatles than Dire Straits. Okay, let's see if we can find some places to put some money to use. Before we do that, let's do a quick little rundown of big picture, not big picture, direct picture, what do we have going on? Now, we have a Broadcom trade, a bull put spread. Quick little note that the numbers you're seeing up here, this loss is actually not true. We're actually doing quite well on this Avago trade. Broadcom, whatever they decide to call themselves these days. Anybody catch that thing where Yahoo is going to change their name to something stupid? Uh, I think that was a fundamental trend in the world when companies suddenly started to change their name. This isn't new, by the way, but probably around 2001, companies decided to suddenly start changing their name to absolutely obscure things that have no meaning whatsoever. Drives me nuts. Not that, Yahoo at least is recognizable and understandable. The new name, I don't even understand what the heck it is and where they're going with that. And obviously, they're going to radically change the way the company is performing by changing the name. That always works. Sorry, my cynicism level is jumping up a bit high this morning. Put up with me, please. Broadcom. It is a 155 by 160 bull put spread. We have Broadcom's trading up around 177.44, heading in the right direction. All is wonderful and good in that trade land. Don't take a look at this P&L because Thinkorswim is doing something really weird to my paper trade account, and it changed the number of contracts. So this is not the correct thing. I have the full correct trade all marked down, so we haven't lost that. But Mobileye, we have a broken wing butterfly on this one. It is a 30 by 33 by 35 put broken wing butterfly. Now, what is broken about its wings? The strikes that we chose have a different width on the lower side. You'll notice 30 by 33 than it does on the high side, 33 by 35. Now, what this does in the trade is it basically shifts our risk from one side of the trade to the other. So on one direction, if we are outside of the butterfly's target range, we lose far less than the other direction. This trade was originally set up to actually return a very, very large amount of money, a good, solid, big return if Mobileye continued down towards the center strike of 33. It's trading at 41 right now. This expires tomorrow afternoon. It is as far away from winning as you can possibly get, but we built that into the trade. Basically, there's nothing to do on this trade at this point. There's nothing to really consider at all. The trade lost, and that's aggravating and regrettable. But we took our bets, and we had a good possibility of winning, and it didn't work. That happens sometimes. The thing is, the trade is basically locked in at whatever its max loss is going to be, which is about 1750. Far less than what we would allocate for a normal risk on a trade, so we're doing okay there. No risk of any further losses. It's really a matter of just letting it expire tomorrow afternoon. Not happy about that one. Never like losers, but part of the game. Let's see, Whole Foods. This is a pretty much standard pre-earnings style trade that, on the other hand, is doing very, very well right now. Let's actually dig into this one a little bit just so that we can see it. Okay. So here's the basic idea that we are dealing with on Whole Foods. As a matter of fact, let's take a look at this. We have an earnings announcement coming up on February 8th. Okay, just making sure that we're all set up properly on this. What we've done is, and by the way, this is the style of trade that we're going to explore a bit more today. We set up a long strangle using the February 10th expiration options. These options expire right after the earnings announcement. Now, it's important that we nail this down right. These options are going to be rising in implied volatility as we get closer and closer and closer to the earnings announcement. It's pretty basic. I mean, the risks associated with the selling an option that expires immediately after an earnings announcement is extremely high. The stock announces its earnings, boom, it jumps up, jumps down. It could, blow through the strikes that the seller has placed and cause lots and lots of pain. Well, the way they compensate for that is really easy. If I'm going to sell you these things, give me more money. We're riding along on that. We're basically using that concept to help drive the profitability of this trade. Ideally, the 29 by 3150 long strangle that is basically part of this trade is exposed to that rising implied volatility. As the implied volatility goes up, it basically influences the price of the options to increase. Now, the problem is that this long strangle is also exposed to a lot of theta erosion, and every day theta erosion pushes in the other direction. We needed to get rid of some of that, and we also needed to get rid of part of the problem in this trade, which is it's darned expensive. So, being smart traders, we jumped in and we used a little trick. We went to the January 27th options. We left a couple of weeks in between here to make sure that there's wiggle room for when the earnings announcement actually happens. But we put up a set of options, a 29 put and a 3150 call that expires before this earnings announcement, and we went short on those. We did two things here. We basically financed a big chunk of the trade, which means that the overall cost is significantly lower, means that we also leverage up with the return we get. And number two, theta erosion is on our side on this side. And it's even happening faster because it's a shorter period. Now, normally, you'd have to be worried about this option right here because a dual calendar is a long volatility trade. It's a very long volatility trade, and rising IV would hurt you. But this expiration right here happens before the earnings announcement, and therefore it doesn't have IV going up, or at least not much, maybe a little here and there, but nothing to worry about. So we play those two together and we create this. Now it's without actually recreating where the implied volatility is moving to, which would take me a little bit of work to get to. It's hard to show you exactly where we are, but in general, we're doing very well on this trade. In fact, we are at a nice $2,000 profit, and I got to double check something here. We might actually be at a point where we might want to just take this thing and walk. Hold on. Okay, Michael, would I take any of these trades today? Let's see. We're going to have a bunch of new trades that we would take. Would I consider any of these today? First of all, Mobileye, no, that's just going away. The general Broadcom trade we did, the Avago trade, yeah, I'm actually still fairly bullish on that. If anybody was looking to get in, I would say that whether you do the exact strikes that we did before or just follow the general concept, that is actually in a pretty good position right now to do a bullish trade. I really like the overall long-term trend on that, so I think that would still be a very viable symbol to do as a bullish trade. Now, there's a couple possibilities. It does have a fairly low IV percentile right now. You might convert that to, say, a bullish call calendar. Basically set a target out probably around 187, 185-ish, and then put a call calendar out on that. That could be a possibility for you. Or just a nice straightforward bull put spread. And I would pick an expiration before the earnings announcement and use that as my expiration, and then look for something, your base short option around a 20 delta, and build something out around that. I think that is still a very viable target for what we want to do. I can't go into a deep trade on that, but hopefully that heads you in the right direction. Let me see here. What are the others that we probably want to consider? Whole Foods. I would say at this point, no. Don't touch the Whole Foods trade now because we're already pretty much well into winning on this one. It is doing great. In fact, I'm practically on the edge of deciding to walk away with a profit as we speak. So probably not the best thing to dive into now, but we will have trades very similar to this that we're going to line up today. So you'll have your opportunity to dive in on those. All right, let me just check on something on Whole Foods. I see. Robin, I think the answer for you about whether you should get filled more, I'd say it basically is the same thing as Michael. With that, this trade is basically won, and I don't. There may be a little bit more room to make money on this trade, but I don't think there's a lot of room to make much more money. And I think you're better off at this point taking what you've got and focusing on new trades. If I thought you could make more money, I'd absolutely tell you right now. But I think your best bet is just to focus forward. Now, let me say a couple of things, and actually just kind of addressing some of the people, the reality recently, and I'm just going to be blunt, is we've had this period of time just recently where we've gone through this kind of market transition period. In fact, let me see if I can show you a little example of what I'm talking about. I think Mobileye was a decent example. Yeah, there we go. This right here happened a lot. We are in a period of indecision, a period of the market trying to change its mind about something. And I'm seeing this a lot. And these periods will show up every once in a while. And bluntly, expect them to happen during your career as a trader. And you better be understanding that there's not a lot you can do about it, and your goal is to just get to the other side. Whatever strategies you use, you're basically trying to predict what is going to happen next in the stock symbol in the market and implied volatility or whatever, using the information you've got on hand. And you set up trades. And you're basically assuming that nothing radical is going to change. Or maybe you're assuming something specific is going to change, but it's going to be based on something that you understand and know. Well, what happened just recently is a little kind of market storm that happens periodically. Now, the interesting thing is you can't see it really, at least not much, in the broad market. I mean, right here when everything was shifting around, what was happening is suddenly all these symbols that were trending in one direction, that were acting in a certain way, suddenly started acting in totally different ways. And it's the market trying to figure out what's going to happen next. And I'm not really sure I can say what that comes from exactly. I don't want to give it a source that may or may not be true, but let's say that people are trying to figure out what a Trump administration is going to mean for the markets, for different stocks and different companies. Maybe people are just worried that we're in one of the longest bullish runs that we've ever had in the market. Forget if right now we're in the second longest or third longest bull run in history, but we're up there. We're certainly approaching the second longest. It doesn't matter if people are thinking, is it positive earnings versus negative earnings? Is it the interest rates changing? Anything. What's happening is things are shifting and changing. Now, what's strange is it's not shifting and changing in one direction. Things that were trending up suddenly started pulling back. Things that were trending down, here, Mobileye, suddenly shot up. These are times you are going to lose money. I have no idea. I mean, banging my head against the wall for the 20 some odd years I've been doing this, I've never found a way to make it so that you do not lose any money at all during those periods. Now, there is ways to manage this. Obviously, we want to try to build out a portfolio that kind of balances different trades off. That is very, very helpful. But if you've got everything just shifting the direction, even that's challenging, because if I have a bullish trade that's designed to work if the broad market goes up, and a bearish trade that is designed to offset in case the broad market goes down, well, if both of those trades suddenly start changing direction, both of them are in challenging situations. So it's a very hard thing to deal with. Luckily, these things typically are fairly short, a month and a half. Just call it a profit storm if you want. The one thing, these are the things that I have found help getting through that. First of all, don't beat yourself up. Don't kill yourself over being wrong over trades. The fact is, it was a situation you had no control over. You were doing your job correctly, and the world just conspired to make you miserable for a little period of time. It will happen. The market loves to make people miserable periodically. It just reminds you that you are living in its world, not it living in your world. The second thing is don't stop trading. I have no problem at all reducing your trading and reducing your risk. That is smart. Don't stop trading. That is one of the most long-term dangerous things for you. The reason is that when you stop trading, you lose your feel for what's going on in the market, and you don't see when that change is settling out and you've got a new normal. So if you're normally trading 10 contracts on this or 15 on that, just scale back to 1 or 2, very small amounts, but keep involved in the market. It's too easy to walk away and then just completely lose perspective on what's happening. And what I find is that as you're thinking that you're saving yourself by walking away completely, what happens is when you get back in, it takes a period of time to catch up on the new normal, and you end up losing money at that point also. So I really do have a pretty firm philosophy of keep your fingers in the market. Now, I don't want you to put outrageous risks out there. If you're not comfortable with what's happening, always take that into account and reduce your exposure, but try to keep playing. That is going to be an important thing. The other thing is you need to use those periods of time to learn. Number one job we have, well, I guess number two. Number one is to make profits consistently, but the number two job we have as traders is to constantly learn what the market is doing. It's our job. That's how we make money. That's how we make risks go away. And if you're not engaged in the market, you can't learn from it. And you're missing out on your opportunity to learn some of the most important stuff, is what's going on when the market's doing weird things or big shifts. Personally, I think we're coming out of that right now. I actually feel like we're stabilizing, like we're heading in the right direction, whatever that direction may be. And we've got a bit more, we're starting to get more clarity about where the trades are heading. And I'm feeling a lot more comfortable about that, which is nice. So I don't know. Well, you can take what you want from that, but encourage you to keep your fingers in at least a little bit. Please don't risk money you can't afford to lose, but part of it is investing in your ability to trade in the near future. All right. Yeah, last year the market looked like it was going to crash in January, then look what happened. Exactly. We've got a lot of weird stuff happening out there. Broken wing butterflies, actually, there's a couple of trades out there that are good. Broken wing butterflies allow you to really protect yourself in cases of really just exactly what happened on Mobileye. Our prediction when we put this trade on was based on this nice broad trend heading down and continuing right to where we expected it to go. When we set the trade up, we didn't do this aggressively, but we put in a mild broken wing butterfly, which is this. And as we get the opportunity, I will do more of these trades. The hard part about this one is that you want to use these mostly when you predict that things could change on you. That's an awful hard thing to predict ahead of time. Who's it? Yogi Berra said things are really hard to predict, especially if they're in the future. Well, this is a case of that. We did good on this one. I mean, I hate losing, but we set this trade up so that even if it failed and went hard against us, it would lose a very limited, very controlled amount. In fact, less than what we would normally risk as a kind of a max loss risk on a trade. Now, once again, hate losing, but if I'm going to lose, I'd rather lose in a controlled, managed way. And that's what this ended up doing. Just looking at the chart, we thought it was going here, and bam, look how fast this thing blew against us. If we did this as a trade in a different way, let's say we just used a standard bear call spread, and put this in perspective. That movement right there would have blown through our strikes and pushed us close to a max loss very, very fast. Probably gone straight by our eject point, our stop loss, and we would have been fighting a major, major loss on that one. Not to repeat myself, hate losing, but I would much rather lose in the controlled way that we just did here than lose in an uncontrolled way. Now, having said that, is broken wing butterflies the miracle trade that fixes everything? No, it actually has some problems. It's a little expensive in certain ways. Your return on investment can be um, challenging to get because of some of the costs, things like that. You don't want to use it in every situation, but in this case, it was effectively a pretty smart move. Um, so, some ideas there. Paper trading to get past the hump, that's fine too. Tim, as long as you're taking it serious. I actually love paper trading. It's a good way to be engaged in the market and learn and understand. But you do need to take it seriously. Treat it just like this is a job. If you show up and, excuse my language, but half-ass your job, you get fired. Well, there's no one to fire this time except you. So try to please your own boss and actually do the job well. That's the one thing that if you're going to do it, put focus on it and treat it real, because that's the way you really learn. Should we close Mobileye or let TOS? What we're going to do is just let this thing expire worthless. There's really nothing we can do to make the situation better. There's nothing to fix it. It is what it is. All we need to do, let's see, we have a 30 strike put, a 33 strike put, a 35 strike put. Let me describe what's going to happen tomorrow afternoon on Mobileye. We are going to have every single one of these options expire worthless. Okay, there we go. They are worth nothing. They don't assign us any stock. We don't get any value for it. Poof, they just suddenly disappear. Now, why is it better to just allow that to happen? Well, 99% of the reason is I just don't want to spend the commissions to close the trade. I would spend money, to close this thing out, probably about $200 that I'd rather keep in my pocket than give to the broker. That's 99.9% of the reason. I'd say there's a 1% to 0.1% chance that Mobileye turns around and by tomorrow afternoon drops down and hits 33 strike. What's the odds of that happening? Slim to none, and Slim's on his horse riding out west. But could it happen? Sure. If I don't have a better option, I'll leave the trade on black and see what happens. So that's all we got to deal with on that one. Good, Tim. That's exactly what you want to do. Take it serious. And absolutely right, Curtis. Paper trading never does replace having real skin in the game. There's a difference there. Let's just take a quick look at that. Emotionally, I can be very detached from a paper trade. It helps me build up a certain set of skills, analyzing the market, understanding what happens when trades move and how they change, potentially designing and building better trades. There's a lot of good things you get out of paper trading. The one thing you won't get out of paper trading is the emotional training that you're going to need. The reason for that is you really don't have anything wrapped up in winning or losing. Now, if you can train yourself to continue with that thought process and continue with that same amount of emotion, that's great. It actually is a good thing, but it's a very hard thing to translate that dispassionate, no emotional state into live money. I've been doing this for 20 some odd years, and believe me, I haven't fixed that problem either. I mean, I get wrapped up emotionally in trades. Emotions tend to hurt you on trades. I've never seen situations where emotions actually help you make a decision. So it's one of our biggest enemies in trading generally. It's just controlling that and making sure that we don't let the emotions kill us. Make fear drive us to do stupid things in one direction, or too much hope drive us to do stupid things in the other direction. Michael, you're concerned that the market's going to shift again after the inauguration? Probably, yes. I wouldn't be too surprised. I would say this is just kind of follow along with what I said. If you're concerned about that, stay in light. Stay in very, very light. But keep your fingers in the game. If you do want to do what Tim said and just paper trade through it, that's fine too, as long as you realize what you are getting out of paper trading and what you're not, and treating it seriously so that you're following it. the inauguration is going to be a sample of what we're going to get for the next couple of years. Um, whether or not the inauguration has any kind of drama, which I don't know, maybe it will, maybe it won't. Um, the incoming administration certainly has the ability to stir up drama. Will it happen? I don't know. I'm not banking on it. But it's going to give you an idea of how the market, which is really just a big, broad bunch of people who are, all reacting and thinking about the same stuff that you're probably thinking of. It's just what's the collective conscious and how is it reacting to the inauguration? And part of that's emotionally, part of it is, is analysis of what do they think the risks and rewards in the future are. Part of it is, I hate this guy or I love this guy. But it'll give you a taste of what we are likely to see as reactions in the future. Because we'll be able to look at the inauguration and say, well, how did the market walk through that? And we can look at the next big crazy event that's very likely to come up and say, okay, how are we going to handle this? It's not perfect, but it gives us a feel. So I'm actually looking forward to seeing what happens. Is it something where I don't have no concerns about what's going to happen? No. But I think I'll ride through it fine. All right. Let's see here. Let's see. All right, let's see what we can do for new trades. That's what I really wanted to dig into today. Any other final questions on that? By the way, you guys got me going. I I like this. This is what makes this fun for me. Having good discussions about different ideas and really, thinking things through and kind of digging into topics around trading. It's why I show up and do this. I get something out of this too. So this is my transaction with you. I try to share what I know and give you my thoughts and opinions and teach you about different trades. And in exchange, I get to have really interesting conversations with people about different ideas. Because otherwise I would be a troll sitting here in my office staring at this wonderful, beautiful new 40-inch monitor and never get out of the house. I'm probably one of the palest people in Florida. I just don't see the sun all that much. So keep it up. I like this. So everybody who's talking right now, thank you very much. All right. So many JPM in the cabinet, well-being of the market should be its focus, don't you think? Should be JP Morgan's focus? The one thing that I always do trust, and I trust it almost completely, is self-interest. Would I like to think that everybody in the government is thinking about the big picture and thinking about the future and trying to make the absolute best decisions for everybody? Yeah, I would love to think that. Am I naive enough to believe that that's true? No, sorry. Call me jaded, but that little fantasy left a long time ago. The reality of it is this: even if people are saying that they're trying to make a broad best decision for everybody else that is going to be the best thing for everybody, they come to that decision through the filter of their own experience and own life. Now, the mistake to make is think that anybody is actually really clearly logical. We pick and choose what kind of facts and information that we consider in our decisions, and then we make a decision based on our experience around those. So if you come from a banking industry where, the best decision for the banking industry and your company is this, when you go into an administration, you're basically going to come at it from that same point of view. And by the way, the best thing for JP Morgan Chase is not necessarily the best thing for everybody in the country. And that doesn't have anything to do with whether it's Democrats or Republicans. I think flat out that is just the way things work. So the best thing that I would say is take a look at the people going into these positions. look at the way they've approached things in the past, look at what they've done in the past, and expect basically the same thing in the future. If that's a good thing for us, absolutely wonderful. If it's a bad thing for us, sucks to be us. All right, let's see if we can turn some fear, uncertainty, and doubt into some trades. All right, we have a couple of, there's my wonderful bug. This is why I'm not sending you a brand new copy of this. And thank you. What do we have coming up? Right now, we've got a whole slew of banks that are going to be having their earnings announcements tomorrow morning. Now, this is going to be our training run on this. This is going to be the kind of first of the real earnings announcement trades that we've got for this quarter. A couple of things to know. First of all, banks are typically not the best companies to be doing this style of trade on, because when you're looking for this kind of an opportunity, and I'll show you exactly what I'm talking about in a second, we'll walk through it step by step. The basic concept is this. When you're coming into an earnings announcement, you get it close to it, the fear, uncertainty, and doubt, the FUD factor, is causing the sellers of options to raise the price of the options. And it's pretty basic. If I'm a market maker, if I'm a floor broker, if I'm a firm that does a lot of selling of options to make money, I'm taking a risk that the stock price is going to change fairly dramatically when an earnings announcement happens. The closer I get to that, the less period of time I have between now and when that event happens, the greater the risk I have. Second thing is, the risk is all very, very heavily focused on the options that expire immediately after the earnings announcement happens. The greatest amount of implied volatility change is all wrapped up in the options that expire within a few days of that event. And that's also pretty simple. There's nothing, nothing too crazy about the idea. There's just very little time to deal with the trade. If the option seller is in a bad position where it gapped way outside of their, way outside the strike that they were using, they have no time to do anything with it. There's no magic trick. There's nothing to make it better. It's just a painful financial trade, painful for them. So these people aren't stupid. They raise the price higher and higher and higher. And if you want to buy those options at that moment in time, and by the way, a lot of people do. There's a lot of long, short hedge funds. There's broad hedge funds in general. Wide variety of people who buy options at that moment in time because they want an insurance policy against what might happen for the earnings announcement. And they dive in and they buy and buy and buy and they drive the price up. Now, I talked about the fear and uncertainty driving the price up a second ago. There's a second factor on the sell side that is driving the price up. Greed. And not to channel Gordon Gekko here, but in this case, greed is good. They need to finance what they're doing. These are people who have jobs, they have lives, they do this as a business. They're going home and seeing their family, hugging their kids. They've got to take the vacation in the summer. You got to pay for the house right now, and the gas to get back and forth to work is expensive. So they have an incentive to try to make as much money as possible. The uncertainty leading into an earnings announcement gives them the opportunity to raise prices quite a bit higher than what the traditional risk is. And I'd love to do this, and I'll try to get to it sometime, but I got a lot more higher priorities right now. I've got a whole set of new tools that I'm building out, and a whole bunch of new tools that are hopefully coming to you guys over the next couple of months. But one of the things I wanted to do, it's lower on my list of priorities, is to actually do this analysis that shows how this works. Implied volatility is implying a certain range of risk. What's the one standard deviation of range that we're expecting to see between now and the expiration on Friday? How much could the stock price move around? And what's interesting is that implied volatility almost always, to a T, overprices that. I'd love to do a little analysis of a broad number of earnings announcements and just on average how much implied volatility does overprice it. We're going to use that. We're going to be selling that extremely high volatility basically working with the side of the sellers and taking and writing that down. As the earnings announcement happens, all the fear, uncertainty, and doubt, the FUD factor just dissipates. Poof, gone. It gets replaced with price movement of the stock. And it's basically translating in potential energy, translating potential energy of movement, which is the implied volatility and the fear, into real movement, which is the price moving. Simultaneously, the implied volatility in the price of the options drops dramatically. And those are also typically on options so close to expiration that they've got very little time value left. So we use that sudden drop to create a profit. Problem is the trade that we need to make that work requires us to have protection. We can't just do a bunch of short options because the brokerage is going to charge us a ton of money. It's too risky, and it's not a cost-effective trade. It fails on a wide variety of reasons. But it's a simple fix. We go out and we buy some long options to protect ourselves, and we create a trade that uses the difference between the two, almost a pairs trade, to create an opportunity for profit. So that's what we have coming up right now. Leading into tonight, we have Bank of America, JP Morgan, and Wells Fargo. Let's dive in and actually look at those. Let's see here. Questions. Bob, being from Maine, I should like the sun? Absolutely. You know what's crazy, Bob, is I think I actually got more sun in the wintertime when I lived in Maine than I seem to be getting now down here living in Florida. I don't know what it is, but I have had just a ton of work on my hands for the last 2-3 months, just absolutely working day in and day out. My typical morning is wake up at 8 o'clock, grab a cup of coffee, a little tiny bit of breakfast, work until about 4:30, take a break, have dinner, spend some time with the family, jump back on the computer and work from about 8 o'clock until 1, 2 o'clock in the morning. That's what my days have been lately. Back when I lived in Maine, I used to get outside, go skiing, snowboarding, had a lot of fun. Haven't seemed to have done that lately. I live in vacation land. I don't know why I'm not vacationing. Oh, excuse me. This is vacation land. This is Sunshine State. Why am I not getting more sun? Broad market decline. What's going on? Let's see. Oh, yeah. I wonder how much of this is relating to the press meeting that our president-elect had yesterday. I don't know. It's hard to say. I'll keep an eye on that. Oh, by the way, Jesus, sorry, I don't mean to be so distracted, but we do need to make a decision here. Whole Foods. Sorry for jumping around. I don't mean to be so distracted at this point, but Whole Foods, we have a nice solid profit in that. I was checking to see if we had a specific profit target on this. We have a profit target on Whole Foods of $1.25. We are currently at $1.15. We are edging up on that quite rapidly. And why is this not there? Okay. I'm sticking out an order, sticking with our original plan. I'm sticking out an order to close at a nice profit, Whole Foods at $1.25. I'm going to put that order out as a good to cancel, which means it's just going to sit there. It may not get filled today, but right now it's got a pretty decent chance of getting filled right away. If we hit that, that will give us about a 35% return on the trade, and we would have been in this trade for, where was this? Hey, 7 days. That's great. I'll take 35% in 7 days. We haven't hit it yet, so let's not count our chickens before they hatch, but this is the trade I am placing right now. I think I had another trade. Thinkorswim, by the way, has been doing really weird things on my paper trading account. But there we go. All right. Getting back into what I wanted to look at which is banks. Let's dive in. Everybody good on everything? Understand what I just did on the Whole Foods trade? I'm just putting a limit order out to exit the trade at $1.25, which is consistent with our plan that we had from the very beginning on this trade. I believe I actually had an order out to do that, and for some reason it got canceled on me. If Whole Foods continues to increase in price value for us, we should be hitting that fairly soon. We get to walk away with a nice little chunk of money in our pocket. Let's see here. Would the profits disappear if the market goes down on Whole Foods? Well, two things driving profits right now. One, where we are physically between the strikes. Currently, the price on Whole Foods is $30.53-ish, which puts us in a beautiful spot, actually. We're right near the middle of the trade range. Now, let me explain something. Where we are right now is good for right now. I would like to see, as we get closer and closer to the expiration, the 27th of January, I'd like to see Whole Foods move closer to the strikes that we chose, either 29 or 31.50. So if we were to have Whole Foods move down with broad market movement down, wouldn't really be horrible as long as it didn't happen right away. We are at nearly the peak of profit for this moment in time and the implied volatility we're at, which is going to give us a really good opportunity to potentially walk away with a nice early profit and just get the heck out of the trade and walk away from the risk. I will happily take 35% return in a short period of time and walk away from the risk. But we're still actually overall in pretty good shape, just broadly. We've got time on our side. We've got implied volatility likely on our side. So here's the other thing to think about, Robin, is if the market were to start going down in a moderately significant way, it's going to drive implied volatility up. That's going to affect Whole Foods. Now, Whole Foods is also having its implied volatility go up because we have an earnings announcement coming. Those two effects combine. Now, this is, implied volatility in the broad market can help us and it can hurt us. The way it helps us is the long options increases in implied volatility. Since they expire further in the future, that effect typically is going to be higher and more significant. So that's a good positive thing. The problem is that if the market believes that this price movement is a short-term, kind of dangerous near-term effect, sometimes the short-term implied volatilities go up faster than the longer term. It's a pretty common thing to see. You'll suddenly see a surge in implied volatility, and the shorter-term options see more of that surge than the long-term. In the case of Whole Foods, that would hurt us a bit because the short options would be going up in value, which basically hurts the trade. It won't be dramatic. It won't be radical, but it could reduce the profitability. So be aware of that and know what you're seeing when it does happen. Right now, though, I'm very, very positive on this trade, and I'm excited to take the profit shortly. So I'm going to leave the order out there. Otherwise, we're going to pay attention. Do I see any immediate risks on this? No. I don't see any kind of immediate present risks that are going to force me to make any decision. So, hey, let's party. All right. Back to trades. Actually, Robin, I'm actually almost in the opposite opinion right now. I think we might almost be asking too little. I think that there's going to be more room for that trade to even move up. Now, I don't want to be greedy. I don't want to be, I don't want to be nuts and overly aggressive. Let's just take our profits and walk. But I think that there's actually more room to make extra money in that. Juan gave you the right thing. Start with the cost of the trade and calculate a 35% gain. And that's basically puts us at 125. So I built in the commission cost roughly, multiplied it times basically 1.35 and came up with a number. That's what gave me my profit target. But you can use just a judgment call on that too. All right, Bank of America. Here we have it. Okay, actually looking good. Let me show you a few things. Let's see. Trim this down a little bit. All right, it's really hard to see on this chart, but every time you approach an earnings announcement, implied volatility suddenly starts shifting. Now, Bank of America's normal average implied volatility is kind of right around 30%. Now, remember that. That's an important thing to understand. As we approach the earnings announcement, specific options go way up in value. Basically, their implied volatility starts going way up. I was saying before that banks are not the best for this trade, and they're not. They really don't see as high a rise in implied volatility as other things. Like if I were to compare this to the rise in implied volatility on Chipotle Mexican Grill, the IV change is just not nearly as high on a bank stock as it is on Chipotle. If I were to look at any of the retail stocks, Bed Bath & Beyond, Best Buy, even Macy's, Tiffany, things like that, all of those get really, really enormous amounts of implied volatility increases because everybody knows that these companies live and die based on their revenue streams. Now, banks, on the other hand, have a lot of different things going on that are less driven by like sales type of factors, or at least a little bit more immune to it. Plus, banks are incredibly analyzed. Everybody is paying attention to what the banks are doing. There's 30, 40 analysts paying attention to every one of these. So the market is more informed about what's going on, and therefore there's a little bit less fear, uncertainty, and doubt. Now, having said that, we still have a pretty decent opportunity here. So let's look at this. The options that expire tomorrow afternoon. Now remember, the earnings announcement is going to happen tomorrow morning before the market opens. To do this type of trade, we have to be in before the earnings announcement goes off. So that means by the end of the day today. The 13th of January, tomorrow afternoon, those options right now have an implied volatility of 60%. That is very, very, very high. But it's still only about double what the longer-term implied volatility is. So one of the first things I want to look at, in general, this isn't always a perfect answer, but in general, is I'd like to see that the short-term implied volatility is at least about twice the longer-term kind of stable, flattened out implied volatility. Now, why does that matter for me? Because what we're really trading when we do this is the shift in implied volatility between here down to here. It's actually even more than that. It's from here down to zero effectively. But this is where we're going to be getting our advantage. Now, there's a couple other things that we need to pay attention. This option out here, or any of these options, still has a little bit of extra implied volatility based on the earnings announcement, but not a ton. Second thing that really drives whether or not this trade is going to work or not is how much do we expect these longer-term options to drop in implied volatility after the earnings announcement. Now, the short-term ones, that's pretty easy. Two things happen. Number one, this is going to go down to at least relatively normal levels. And number two, these things are expiring tomorrow, and implied volatility will matter in no way for those. These ones, on the other hand, are going to be important for a trade. So let's walk through some of the pieces here and figure out whether this is a good trade or not. First of all, the trade is effectively between now and, at worst case, 4 o'clock tomorrow afternoon. Very, very short-term trade. I want to figure out where I'm going to stick my strikes. Now, just because of the nature of the options market, way things work, there's a kind of a sweet spot that we found on these trades, and that is right around a 1 standard deviation range. Now, the way we find that is actually fairly simple. Thinkorswim gives it to us. Based on the implied volatility, it can calculate out what a 1 standard deviation movement range is between now and the expiration of the options. And in this case, it's about 80 cents. Now, there's a few things that you need to consider here to make sure that this is an accurate number or a good rough place to start. First of all, take a look at this implied volatility. What I really care about is what's the implied volatility at the money. Regrettably, what Thinkorswim cares about is taking a big average across a bunch of different samples and creating a number. So sometimes this number that you get here is a little bit off. You'll notice that the implied volatility at the money is about 58%. It's a little lower than this. I would probably go to the lower edge of this. Now, how do we use this number? Basically, I'm trying to find strikes to do the trade. I do the current price minus this, so that's about 22.82 minus roughly 80 cents, maybe a little less, puts me at 22. All right. By the way, right off the bat, I can see a problem, and we may not be able to turn Bank of America into a trade. One of the things that's a challenge is the price of Bank of America is very low. It makes it hard to do this. But let's continue through the walkthrough. I'm going to take and go short. I'm going to try to short this implied volatility into tomorrow afternoon. So 22 strike here, go short on that. I'm buying a 22 put. Next, I want to go the other direction. 22.81 plus roughly 80 cents brings me up around 23.60. I would go with the 23.50 strike, and boom. So we have a $1.50 spread between these two, and we receive about 26 cents credit, which regrettably isn't a whole lot in this situation. And we have a short strangle. Basically, this is the trade that we've got at this point. And there's a problem with it, actually a list of problems. Number one, if you ever see a trade that has this great big huge long line that goes off and never seems to flatten out, that right there is an unlimited risk trade, or it may be limited risk, but extremely high limited risk. That is something we want to avoid at all costs for two reasons. One is I just don't like the max risk. I don't like the possibility that if something goes wrong, I can get my account wiped out and I can have the brokerage come after me and my family and my car and my bank accounts. That's one thing I absolutely want to avoid. And number two is a practical one. The brokerage would charge you an arm and a leg in margin to take this trade. And it turns this profit that you might have a decent chance of getting into something that's not a smart trade at all. So we fix it. To fix it, we have to turn around and basically protect ourselves. Now, what we're doing is we're trying to use the difference between a high expensive option, high implied volatility expensive option, played against a less expensive option that, or basically a lower implied volatility option. So I want to look through the options book. You'll see it goes 60%, 39%, 34%, 33%, 31.2, 31, 30.51, 31. Okay, what I want to try to do is get far enough out into the future where the implied volatility effectively starts kind of leveling off and not dropping anymore. But I also have a very strong incentive to make that date just as near to me as possible. So there's no advantage going way out here to 50 or 100 days. In fact, that hurts my trade. The cost of that option would basically reduce my return on investment and make it a worse trade for me. So expiration-wise, I want to try to get as close to me as possible. So I'm looking for a little bit of a compromise. For me, right about here, right where it hits 31.25, you'll notice it's got a very small drop between this and the next one. That's just about the sweet spot right there. So I am going to start out with that. I'm going to use the same exact strikes that I had before, and in this case, I'm just going to go long. So a 22 by 23.50. 22 by 23.50. All right, now that portion of the trade cost me a bunch of money. It took that credit that I was receiving a second ago, and it offset a big expense for me to protect myself, which was this exact same trade long strangle. Same strikes, opposite direction. Now this does two things, and you've got to think about how we're going to use this. First of all, this long strangle that we just bought to protect ourselves, we are not going to keep very long. We're renting it. We're using it for a day, basically between now and tomorrow afternoon. And its job during that time is, if the stock moves rapidly up or down, it creates a profit that offsets the loss that we would have gotten in our short puts, our short strangle. And it does that fairly well. What it creates is actually this interesting effect where we can make more of a profit as we approach these strikes. And then once we pass the strikes, we start losing profit overall. The loss on the short options overwhelms the gain we get on the long options. A few things we need to take into account, because if I analyze this right now, it's not actually going to give us the full picture on the trade. And that is a problem that we need to fix. So what am I seeing here? Well, what effectively ends up happening is you're creating a dual calendar. You're shorting the options that expire immediately after the earnings announcement, long on the options that are expiring further off in the future. But this dual calendar has a very, very different way of working. We're not using the same implied volatilities across all of them. You're leveraging the implied volatilities in the short term against the implied volatilities in the long term. The problem you get, though, is when you first analyze this, you're going to get this trade that looks amazingly good. It may not be. We need to do a quick little test to make sure that this is actually a good trade. This is where a lot of people get caught up. People can get, if you don't do this next step properly, you can make lots of mistakes in this trade. So let's see here. I need to jump back to the chart, and I need to get a little bit of simple information. What were the previous earnings dates? And I worked to kill another tree. You should see my desk is covered in notes. Oops. There we go. Yeah, David, that's a good way of putting it. Banks have a massive flywheel. It's continuing to spin regardless of what's going on. And by the way, another thing to look at on that is that banks have this inherent, they used to call it the Greenspan put. It's this inherent protection, especially with the banks we're looking at, Bank of America, JP Morgan, and Wells Fargo. There is no way that we are going to let those three banks fail. You know, if they look like they're going to fail, the government will swoop in and make sure they don't fail, because if they fail, it is an absolute crisis to everybody. So it does dampen down the risks on things a bit. Tom, good luck presentation. Yeah, I'll take a look at that. I'm not going to do it during class because it would kind of probably bore everybody. But yeah, let me hold on. How do we know the bond bull is dead? Okay, yeah, let me dig into that one. Okay, so what am I doing now? To figure out whether or not this trade is a good trade or not, we have to have one number, which is what is the target that the implied volatility on our long options is going to move towards when this earnings announcement is passed. There's a little bit of implied volatility wrapped up in the options we just chose to protect ourselves with. So let's see, the February 10th right here currently have a 31.25% implied volatility. That basically represents, a portion of this represents some risk relating to the earnings announcement, but not a lot. So this is going to drop. Number one risk to this trade is this. If this drops a lot, it drops the value of our long options to the point where it doesn't matter how much money we received in a credit, we still lose. We need to model that out. Here's how I do it. There's a couple of ways. You don't have to do exactly this, but I'm going to go back in time, and I've got October 17th. I have July 18th. I have April 14th. January 19th. All I'm doing is I'm collecting up previous earnings dates. And I'm going to go back in time and see what happened during those. See, this is one of the interesting things about playing with volatility, is it actually does have very, very consistent, understandable, predictable patterns. And that's why, one of the reasons why I like to use it. You know, if I can make money in a predictable and understandable way as opposed to a random and hopeful way, I'd much rather do that. So I got a nice list of past earnings dates. I'm going to think through the situation I'm in right now, and I'm going to put myself in the same situation. So what is the trade that I'm going to be dealing with tomorrow afternoon? Well, that trade is going to basically be me closing down these long options, and basically the short options, as long as things don't gap too much, will be expiring or coming close to zero. So the biggest thing that's going to affect my trade are these two long options, the February 10th. They're about 29 days in the future. Using the Analyze tab on Thinkorswim, I go over to Think Back. Let me reset this to today and jump back in time. So I had an earnings announcement on 10/17, October 17th. Oh, Monday last time. That's interesting. And I want to see, let me see. Okay, yeah, this is past the earnings announcement. I'm assuming that announcement was first thing in the morning. And the implied volatility in the market on the options that were roughly 30 days in the future is about 25% there, 24, 25% there. Okay, let's just call that 25%. Jumping back again, July 18th. There, that's the time frame. All right, roughly 30 days in the future. This one, wow, about 21%. By the way, this is not looking good. I'm just going to take one or two more samples, and I can probably tell you right off the bat that this is not going to be a workable trade. So we're probably going to move on just so that we can get to something that will work. But let's do one or two more samples, and I'll show you what I mean. April 14th. Actually, I'm going to go to the 15th just to make sure that we've got the right date there. And we've got implied dropping to about 24, 25, about 24%. We're getting a trend. 25%, 21%, 24%. We're getting a nice little range over which this works. Going back, January 19th. Now remember, every one of these samples that you do, you have to put them into context about what's going on. You can't ignore the fact that during January last year, we were in the middle of a massive correction, and that was going to affect implied volatility. So honestly, this sample is probably not relevant. Yeah, see, we've got about 39, 40% implied volatility. It's not representing what we're doing right now. I'm probably not going to even add that into my calculations. All right, let me work with what we do have and what I do feel fairly confident on. We've got a 25%, a 21%, and a 24%. Now, that implies to me that we're going to be dropping somewhere, in this case, probably down to 24%, 25%. All right, let's go back and see what that means for the trade. If I were to look at this trade right now, that doesn't look like all that bad a trade. In fact, I'd build it up and could probably make some decent money on it. But the reality is that these two options are going to drop in value. They're going to drop from roughly 30% down to, let's say, 24%. So I need to go in and adjust volatility on those. So let's see the February's, and I need to subtract 6%. All right, right out of the gate, no, not going to touch that one. I should have known that one earlier. But so what's happening here is implied volatility is not being priced up enough, or worse, we've got implied volatility in the long options that are basically too high to make this work. There's too much of a drop in implied volatility in our long options to make this trade work. You can see that the P&L now shifted completely below zero. Don't get tricked here, though. This does not mean that you should rush out and flip this trade upside down and do it just the opposite. What this means to me is that based on my expectations, what I think are rational expectations, this trade doesn't make sense. And the key is it's not so much that it's going to go and do the opposite of what I want. It's just that it doesn't make enough sense for me to take it. I want a trade that's got a clear advantage, that I've got a nice solid edge. In truth, there's a chance this trade, if I took it, would actually win. But I don't see enough edge in here to guarantee that and to make me feel comfortable taking it. So as soon as I see the bottom of this little loop, after I've adjusted everything, go below zero, actually, I'd like to have it up above 10% profit, I just walk away from the trade. So there we go. There is number one. Now, as we do this, there's a lot of these coming up for possibilities, and we're going to see these trades day after day. And I will shortly have a tool for you to actually have those laid right out for you. We're going to go through a lot that we're going to throw away. Just realize that. It's important to go into this knowing that, or expecting that we're going to throw away a good chunk of these trades, and we're going to take the ones that make sense, the ones that actually give us a really solid advantage. So let's take and see if we can do Wells Fargo and turn this one into something that makes sense. I'm going to do this one a bit quicker. Does anybody have any questions on the process or understanding what we just did? Because right now I want to make sure you understand it, and then I'm going to go through and try to nail a trade or two. David, how do I use comparable strikes for the previous volatilities? You really don't have to. All of this is a relative drop, okay? So all you really need to do to get a good enough estimate of what's happening is look at the at-the-money strikes. So when I go back in time, I really don't care about what the movement was. I don't care about what the gap was. What I care about is, where did the at-the-money strikes end up as far as implied volatility is concerned? And that's going to give you a pretty solid feel for what you're going to have this time around. Now, in reality, is that perfect? No, we could beat our heads against trying to be perfect. Perfect is the enemy of getting anything done. And by the way, if you ever think you've got a perfect analysis, you're probably lying to yourself. Or I know I would be, because it's just impossible to do. Everything we do is based on kind of a fuzzy probabilities. So what we're trying to do is just get a general sense of what will happen. Now, here's a couple of truths about this. At the money is, in these particular cases, is likely to be a lower implied volatility than out of the monies. As you get further away, there's likely, in this moment in time, to be what we would call a volatility smile, which means that implied volatilities will generally be increasing as you go in either direction away from the center price, the at-the-money price. If you use the target that's the at-the-money, that's actually a moderately conservative estimate. It means that there's a chance that you're going to have less than that. Now, there's also that odd chance that you might have more drop, but it gets you pretty close to the right target. So we can put a lot of effort in trying to be perfect, or we can go with good, solid information that gets the job done. And that's kind of what I'm working with here. But good thoughts. I mean, you do want to be more accurate if you can. Just don't kill yourself trying to get something perfect that's not going to actually help you much. John, you posted, how do you get the E and D showing in the chart? E and D. Hold on. Let me see. Bank of America, E and D. What are you talking about with those? I'm not really sure what E and D are. Oh, earnings and dividends. Actually, I would, just to keep things moving, I would say that the best thing is just look up corporate events in the Thinkorswim guide, and it'll walk you through turning that on. It's just a setting in your platform. It's a pretty simple thing to turn on, but I'll spend 10 minutes trying to figure out where it is right now. The Thinkorswim help desk people will absolutely help you, and it is in a little instructions file on the Thinkorswim platform. I'd love to give you an answer and help out, but it would slow us down a lot, so I'm going to move on. All right. I'm pretty sure that you can get that information. Looking at Wells Fargo, trade number 2, same thing that we're going to do here. January 13th expiration, tomorrow afternoon. Right now, it's at about 47.15%. All right, I am a little bit worried that this may not actually be a solid trade. A couple of things that tell me that right off the bat is this number right here is not quite double this number out here. A couple of things that might affect this. If the implied volatility drop is going to be smaller, a much milder drop, it might turn this into a good trade. But we're kind of starting off a bit, I don't know, behind the eight ball, if you want to call it that. It's going to be hard to make this trade work well. So let's take this from a different angle and start out looking for our earnings or our implied volatility target. In this case, the options I'd be using on my long options would be, well, you see here, it's actually 15 days out, January 27th, and these things are actually pretty much flattened out to where the long-term implied volatility is basically at. A little bit high, but not too much. 26.8%, which is pretty close to 26.66, 25.99. That is where the implied volatility starts flattening out. So that right there is where I'm going to start. I'm looking at 15 days in the future. So Wells Fargo, getting our earnings dates here is 1/13. 10/14. 7/15. This is always an interesting situation because all of these trades that I'm doing really rely on you analyzing the trade pretty much real time and seeing what's happening right then. I could come up with an answer yesterday that's different from my answer today. That means that at that point in time, I'd be getting an advantage from the prices and actually having a decent trade. It might be a different answer today. It also means that it makes it very, very hard for me to prep with a pre-done answer before I got into class. So there's a bit of a risk here. We may not hit anything. Okay. Going to do the same process again. I've got a list of past earnings announcements. In this case, I care about what's the implied volatility the day after the earnings announcement on the option that expires in about 15 days. Same thing. I'm just going to reset. And we have hold on. What did I see there? Oh, okay, that's the next one. No wonder. Sorry, getting a little confused. Going back to October 14th. So this is the day that we would have been doing this trade, and we would be looking at the options that expire in about 15 days, and they are hitting right about 19, right about 19. Okay, so 19%. July 15th, same thing. About 16, 16 and a half, 16, 16 and a half. We'll just say 16.5. And April 14th, actually we'll be looking at the 15th, which is that right there. And the applied volatility is about 18. All right, we're getting a trend here. If I go back and do the January, remember this is right in the middle of a correction, so probably not the best data. Yeah, see how this is right in the middle of the market correction. Everything is running high. Implied volatility is high. So this is about 31. I'm not even going to consider this. Right now, I've got a 19, 16 and a half, and an 18. I'm just going to rough this in at about 18% and see where we stand. Now, I can tell you very, very quickly that this is not necessarily going to be a great trade. I'm going to throw it together fast, but my guess is that if we're going from 26% down to 18%. That's a pretty big drop on the long options. We're not going to get the edge in the trade that we need. So 2 dings against this one right out of the gate. Just to be complete, see, we're looking at roughly $1.50 here. Let's see. That's based on 47%, so probably a little bit inside that. Well, we're not going to have too many options there. We're looking at roughly 52.50 by 54 to 55.50. Okay, so we're looking at a 52.50 short put, 55.50 short call. In this case, going to use the January 27th, and I'm going to do the same strikes, just long. 52.50 long and 55.50 long. Gives us a 75-cent debit. Looking at this. Now, we need to take the 2 long options, which are currently at about, let's say, an average of 26%, and make the adjustment so that they're closer to 18%. So that's basically dropping 8% implied volatility. That's huge. This is not going to be pretty. If the trade looked like it looks right now, I would happily take it, no problem at all. But changing this implied volatility kills it. Damn it. All right, moving on. As I'm going, ask questions, especially about the trade. Is everybody following what I'm doing? Because this is the process you should kind of get used to and get comfortable with as we're going through this earnings season. This is what's going to basically find you the trades you want. So far, I'm not exactly doing great on finding the trades. We've got one more possibility that might work out for us. Cross our fingers and see what happens. I've got Wells Fargo, Bank of America, and JP Morgan. Let's see, what do we have for this? Paul had to step away. What was the BAC trade? We basically went through a faster version of the same analysis and came up with the answer that BAC was not going to work and Wells Fargo was not going to work. We're down to JP Morgan. So please, knock on wood, this is going to turn into a trade. If not, we've got a stack of these coming next week, so we'll have plenty of time to do them. But I'm not going to take a trade that's not a smart trade to take. So let's see what we can do here. Okay. How do we stand on this one? Pretty close to JP Morgan, actually. Wells Fargo. I'm a little bit concerned we're not going to get what we want. A few things that are nice about this one. Let's look at the positives and negatives here. I like the fact that this is a much higher price stock. We're dealing with $86 here, and that's good. It helps make the trade easier to make. We can find strikes that are better. We typically end up with a little better profitability, and that is real good there. Bad side is this. 42.86% implied volatility, which is playing off against about 23%. The problem I'm seeing, this implied volatility is just not super high relative to this. I want to see this number higher. It's good to see this at least twice as much as this. It basically makes me worry that I'm not going to find a trade I like. Now, we can use as we go through these implied volatilities, as our long position, we can use a relatively short-term one, which is the January 27th. That's down about 24.7%. That's pretty good. Shorter term is better for us. So let's build this out and see if we can make it work. All right. So first step. Once again, we need to find the strikes. We're looking for relatively close to 1 standard deviation range. I've got 43% implied volatility. That translates into $2.16. And $2.16, let's see, that's a little bit elevated, so it's probably a bit high. I'm going to shift it down closer to $2. You generally want to be a little on the inside of this anyhow. Current price is $86.37. So if we take $2 off of that, we are looking at 84, either 84.50 or 84. I'm going to use the inside. I'm going to use 84.50. Now I can see one good thing right off the bat. Nice tight spreads, 38 by 39, and a relatively high credit that we're about to get. So that's good. $2 up is 86.88. I can either go on the inside, which is 88 itself, or 88.50. I already trimmed a bit from this. Probably should go the 88.50. We may play with that a bit. So the strikes we're using, 84.50 by 88.50. We need to go out to our protective options and go long on those same strikes. So 27th of January, 84.50 put, long, and 88.50 call, long. Translates to $1.11 debit, or $1.12 debit. Okay, that's workable. By the way, strangely enough, higher price debits actually are a better thing in this trade. We're still going to make a good solid percentage return, but with a higher price, we actually end up having to buy fewer of these contracts. Commissions-wise, it works out better. Let's take a look at where this thing's going to go implied volatility-wise. So fingers crossed, everyone. And we are going to go to the chart and basically get the last couple of earnings announcements. October 14th. July 14th. These guys love the 14th. April 13th. And July 14th. Okay. By the way, as a little tease to the future, I think I've got a spreadsheet. I've been doing a lot of work on the spreadsheet that we use around this. And I think, fingers crossed, I've actually got a spreadsheet that will find all of these earnings dates for you and actually show it to you right in the spreadsheet. What I really want to get to is also being able to see all the implied volatility changes and have everything laid out right there for you in just a click of a button. But for now, we still have to do a little homework. Okay, so same process, same thing we did before. Almost repetitive and boring. All right, give me a little bit of love on this, please. October 14th, there. 14 days in the future, we are looking at about 17 and a half, 17 and a half. Okay, 17 and a half. July 14th. Okay, we're looking at the 15th. 15 and a half. This is good. Okay, April 13th. About 18. I'm going to just skip the January because that's a skewed number anyhow. Going to go back to October 13th. And 22, 23. Well, this is close 22. And one more. Let's do that. And about 15. Okay. This isn't overly optimistic. The most relevant ones, the last three, 17 and a half, 15 and a half, and 18. By the way, the July timeframe, for some reason, we had a lot of implied volatilities go really low. I'm not sure what drove that down, but that was, I generally kind of make a little mental adjustment on that one because it was a little out of whack with everything else. But we do have a 17 and a half and an 18, and I would say the equivalent of, say, a 16 and a half, 17. If we want to just basically target 17 and a half I think that's pretty reasonable for the expectation this time. Now here, okay, we have an actual possibility on this trade. If we think that this trade is going to end up with an implied volatility of, say, 17.5, maybe 18, now notice that the last couple of trades we had, especially Wells Fargo a second ago, we had an 8% drop, and a difference of 8% from where we were to where we expected it to be. In JP Morgan, this is not even close to that. We're looking at maybe a, let's see, 2% drop, maybe, and probably about a 2% drop, maybe a tiny bit more. Oops, that already had an adjustment built into it. All right, here's the risk there. Okay, this is more realistic. Sorry about that. I guess I've been analyzing this before and forgot to clear up my numbers. We're actually going from 23% down to 18%, actually almost 24. So in this case, we've actually got about a 6%. All right, let's do that. I thought that looked a little too good to be true. Okay, the key here is this. I want to get, all right, I actually overshot a little bit. I wanted to get this roughly 18. It's not bad, but when you're doing this, you have a target implied volatility in mind, and you want to model it based off of that target implied volatility. So here we are, and this is about 18-ish, maybe a little extra. And this is the trade we end up with. Now this one is by far the best of the bunch, but it's still not very good. So I hate to say it, but this is like that fishing show where you sit and watch two guys in the boat the whole time. They don't come up with a fish. As much as I want to do one of these trades, and we put a good effort into it, it's not producing a trade. This happens sometimes. Be disciplined. You don't take a trade just to force it. Taking a quick look at this, what do we really have here? Well, if we did a jump down to 85 or a jump up to 88 and really nailed the strikes pretty good on the trade, we had a chance of making, let's see, hold on. Say 300-ish on a $1,200 trade. That's about a 25% return. Minus some expenses, probably a little less. We could possibly hit that. More likely would hit maybe a 15 to 20% return in the middle. We could take this trade, but I don't think that it's giving us quite enough of an edge to really want to take the risk and put our money into it. A couple of things to pay attention to. Our break-even points are down around 84.47 and 88.51. So let's just take a really quick look at that. Hold on. What did I say? 84.50 and 88.50. Now, why do I want to pay attention to this? Well, I just want to take a look at previous earnings announcements and see what has JP Morgan done. We've had a couple of decent, moderately big gaps, nothing major. In general, nothing terribly exciting happens during the earnings announcement. A little bit of movement, not crazy. Now, that's a good thing for us. It means that we've got a little more control in this trade. Every once in a while, we get a little bit of a gap, but nothing major. So if we zoomed in on this one and looked at it, do we think that we would stay roughly between these two lines? These are our break-even lines. Ideally, we actually move towards them, but not all the way. We want to hit close to the strikes. In this case, 88 is perfect for us, and basically 84 is perfect for us. It's a decent chance. But once again, we're just not getting paid very well to take this trade. I would love to make 20% on a trade, but the best way to make 20% on a trade is have a trade that could give you 35 to 40%, and then go for a nice easy fill and an easy exit. And I don't think that this trade's going to give us that opportunity. All right, so we just beat our head against the wall, but hopefully you got an idea of how this pattern works. We're going to be using this a lot in the near future, so don't think that this is wasted. Oh yeah, start hammering on the tech and trade desk to make the earnings feature on Analyze tab fully functional in paper trading. Absolutely, definitely do that. Thinkorswim has a brand new tool that gives us a ton of this information, but they only enable it on the live platform. I like it over there. It's great. I really want to have it on the paper trade platform, so definitely do it at Juan was mentioning. Robin, can I slow down the part where I look up the IV on ThinkBack? Sure. Let me walk through that. I'm going to move forward and I'm going to try a different style of trade on a pre-earnings situation. And as I do that, I'll walk through the same process. Just I'll do it a little slower so that we can take some notes. Sorry, I just had 3 symbols that we needed to get through and I wanted to make sure we covered those. Jim, do I prefer pre-earnings versus earnings trades? I don't know if I have a preference. It really depends on the situation. And let's take a look at that. If you've got a market that's moving around a lot and there's a lot of volatility and uncertainty, pre-earnings trades require you to be in them for a longer period of time. That's what we're going to look at right now. And those trades expose you to more time for the market to move up or down against you. In stable markets, I find pre-earnings trades to be wonderful. Nice, easy to manage, good trades. In more chaotic and unstable markets, I tend to be a bit choosier on them, pickier on which ones I take, because I don't want to be exposed for a long period of time to a trade that has to stay within a basic range. They're good trades, they're great trades, but they do have that risk. On the other hand, there's a situation where the earnings trades can also be good or bad. In fact, I've had entire seasons where the earnings trades were horrible. They just didn't play out very well at all. And the reason for that was that the implied volatility was really skewed and in a weird place. The long options implied volatility was just way too high, and the risk of it dropping a lot just made almost every trade not work out. So there's periods of time when those trades just don't work. Knock on wood, we're not having that this time. Please, let's not. That'd be very frustrating. I think we're going to go into a decent earnings season now, but we really do want to kind of pick and choose the trades based on their own merits. I try not to play favorites, but there are times when certain markets favor one strategy over the other. How do I set the 2 break-even lines, John? These ones right here, all I did was I have a drawing, which is a price level, and I literally just, hold on as I mess everything up. I literally just draw a price level here. I never quite get the price level right, so I just right-click on it, edit property, and then change that number to whatever the break-even is. I got the break-even number, let's see, by doing the analysis and adjusting the implied volatility, and then I'm really just seeing where the P&L line crosses 0, break even. And all I did was I just grabbed this line and I dragged it over to land on break even, just so I can visually see where it is. There was no setting or anything. It was just me manually doing that. Let's see. Let's see. John, where in TOS do I get that form to input the data? I think you were asking about these lines. Once you draw a price level line on there, you just get your mouse close to it and you right click. And then click Edit Properties and it goes right there. So I kind of do it intuitively now. Done it too many times, but not too hard to do. Pre-earnings seems much easier to find ones that work. Not necessarily, Bob. I think that you're a little biased on that. In my personal opinion, I've found seasons where pre-earnings trades were outstanding, and I've also found them where pre-earnings trades were terrible. It really depends on the climate and the environment you're in at the time. The nice thing that happens is that relatively quickly into the earnings season, by about next week, I would say, we'll have a fairly decent feel for what is generally working and what's not. And we'll tend to focus on those trades a bit more. It helps filter out all this extra work. But we're not there yet. We still need to poke around and make sure that we're getting the trades that work or don't. And as I said, sometimes pre-earnings trades will work out great. Other times they won't be working great. You'll have a hard time finding good ones. Other times you'll have earnings trades that work wonderful. Sometimes they don't. As I said, I had a whole earnings season once where I just literally banged my head against the wall and couldn't find a darn trade to take. Extremely frustrating because I usually make a lot of money on these trades. But the one thing I don't want people doing is trying to force a trade to happen when it doesn't actually look right. Now, that's dangerous. As long as you analyze the trade and take the ones that are right, and we'll work on that piece by piece as we go, you'll basically be creating good trades. Focus on what makes the trade a good trade and choose the ones that fit that criteria. One, overnight conclusion on earnings trades. Yeah, that is a nice advantage. Most of the earnings trades we take, in general, will be done in one day. We put them on one day, and most of the time, majority of the time, they're done the next day. That's not always the case. We sometimes will stretch it out a little tiny bit. There is a possibility that you can put the earnings event trade on a few days beforehand. That gives you an advantage in one way. It gives you slightly wider strikes, and it gives you the advantage of having a little bit of time erosion on your side to help out in the trade. That can be good. The flip side is that sometimes the implied volatility is still moving into the options, and the implied volatility might be a bit higher closer to the earnings announcement. There's a trade-off there, because while the implied volatility is going up prior to the earnings announcement, theta erosion is also eroding that and pushing it down. Sometimes you get a situation where implied volatility moves up enough to overcome theta erosion. Other times you get a situation where implied volatility doesn't change too much and theta erosion makes the trade a little bit worse. Don't think that there's one simple answer, and don't think that doing the trade on the evening of the earnings announcement is always the absolute best. I actually took a look at these trades a couple days ago and didn't take them then, but I was looking for the opportunity. And I really would have been happy to put those trades on at that moment in time if the trade looked good. All right, let's move on and take a look at some pre-earnings trades and see if we can find some of those. Well, Richard, I would say that they have different risks. Let's put it that way. Excuse me, my throat's really dry right now. Earnings trades and pre-earnings trades have very different risks, and they are managed in different ways. Let me jump over to pre-earnings trade, and let's walk through that. And as we go, I'll try to talk through some of the different risks you've got on this trade. Now, what I'm looking for in this situation is slightly different. In fact, let's go and just do a visual on what I'm talking about. All right, this is pretty good. Hold on. This is a pretty good one. I wanted to be able to show something to you on a chart. When we're dealing with pre-earnings trades especially, what we're dealing with is this heartbeat pattern. Notice this green line, that's my implied volatility. You'll notice that the peaks line pretty closely with all of these earnings. This is Chipotle Mexican Grill. And you've got implied volatility going up, boom, drop, up, drop, up, drop. Almost heartbeat, boom, 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 boom. It's like you're hooked up to an EKG at the hospital. It's not a pleasant thought. So the trades that we talked about before, that we just tried to do, basically focused on this. The drop in implied volatility after it's risen up, collapsing down and using that to create an advantage, to create an edge in the trade. So That's one style of trade. We're dealing with volatility, though. We've got all kinds of possibilities, which means that we can also play the rise in implied volatility. And that's what we're about to look at. To do that, we want to be back a little bit towards the beginning of the process, early enough so that implied volatility hasn't risen way up, and there's room for implied volatility to increase. So in this case, we're looking for symbols that have an earnings announcement probably at least about 20 days in the future, and probably out to maybe 34 days in the future. A couple of criteria we need to have on this to make this work. They need to have a good broad set of extended weekly options, because we're going to need to bracket an earnings announcement with a short option and a long option. So to do that, we basically need good active weekly options. We also really need to have a stock that is a fairly active symbol that has a lot of options activity and we can get in and out of relatively well. Ideally, we want something with a higher price because it makes building the trade much easier and much more effective. And we also have to have something that has that nice, clean pattern of implied volatility change. Now, I've done this for a while, so I know, there's a fair number of them that I've worked with and pretty comfortable with. Let's see, going out to the pre-earnings range, Chipotle Mexican Grill typically is a really good version of this. Let's see, it's a little bit close. Priceline can be an excellent version of this trade. Let's see. If we have options that are a deep enough book, Nettie's might actually be a decent possibility too. NVIDIA, that's a good one. Palo Alto Networks, a little bit too far out in the future to play with, but that one's definitely going to be up on our radar shortly. John Deere, or Deere & Company. We're going to actually have a whole bunch. Alta Salons is another great one. Play with that one all the time. Broadcom is another one. Costco is another one. All of these are potential trades coming up. Akamai is another one that in the past has actually been quite a good trade for me. Let's take a look at a few of these and see what they look like. Okay, one of the things that we want for this particular trade, same concepts, but we do need the symbol to be moderately stable. We want it so that the implied volatility has still got plenty of room to move to get up to its peak. And we don't have to get it so early that we're before any movement, but we do want to have at least the meat of the movement left. Priceline is actually looking really good right now. So let's take a look and see what we've got on that. I'm going to jump back to the spreadsheet. I need to know, when is the earnings announcement? 4 o'clock on the 6th of February. Okay, good. That gives me what I need to work with. So 6th of February. I need to find two sets of options, one that expires after that and one that expires before that. So I've got the 3rd of February and the 10th of February. Now, 10th of February has an implied volatility of about 20.6%. And the 3rd of February has an implied volatility of 19.7%. A couple of things that we need to do a little bit differently on this trade. And I'll give you a couple of kind of warning signs that you should be paying attention to. You notice how the implied volatility is 18, 17, well, just about 18, 18, 19, 20. It's a little bit higher here, but then it suddenly jumps up from 20 to 24. Look for this, because this right here is contradicting the expected earnings date that we're working with right now. Now, I used a website, let me see, called Earnings Whisperer. And let me just double check this. Priceline, PCLN, February 6th. All right. Couple of things to point out about this, important little nuances to pay attention to. First of all, you see this little dash right here? It's incredibly obvious, but that means that that is not a confirmed earnings date yet. If it was a confirmed earnings date, we would see a checkbox here. Now, what does that mean for us? Basically, companies have a consistent pattern of releasing their earnings. They have a certain time frame that they do it, and they try to be as consistent as possible. That generally communicates to the market that their CFO has good control of the finances, manages the books well, and is capable of putting out a number on a regular date. So there's a big advantage and a strong incentive for companies to consistently do that. That does not mean that periodically things don't change. And some companies are absolutely piss poor at doing this. Lululemon is the bane of my existence on pre-earnings trades. In fact, I don't even take them on Lululemon anymore because they just can't seem to get their act straight and put out their earnings number on any particular date. It makes me very worried about how their finances are managed. I want a CFO of a large company to be a neurotic, obsessive compulsive, must do things in certain ways type of person. Because I want them to have tight control. Now, Priceline in general is pretty good about things. But there's an interesting thing going on here. Earnings Whisperer, I don't know how they do this, but they've got a pretty good track record of building up earnings announcement expectations. They nail them probably high 90% of the time. But there's a conflict here. February 6th happens between February 3rd and February 10th. So theoretically, we should see inside the options chain a difference in implied volatility, a small one, between here and here. And we see a bit, but not much. All right, that right there is a bit of a warning sign, a little bit of a red flag. Doesn't mean that we don't take the trade, but it means that we be a bit more cautious about how we set up the trade. So what I'm going to do is I'm actually going to, instead of playing the February 3rds against the February 10ths, I'm going to play this a little bit more cautious and play the February 3rds against the February 17ths. The core idea of this trade is that the long options are going up in implied volatility because the earnings announcement is basically increasing the risk to those. To have this work, you need to have the earnings announcement happen between these two dates. If I set the trade up and the earnings announcement fell outside, or somebody announced, oh, by the way, we're doing this on the 12th, not the 6th, suddenly my trade would go against me and I'd lose money. Now, I would rather spread this out and maybe get a little bit less return on investment, but take a safer trade than expose myself to that risk. So I'm going to spread it out a little bit. Now, let's talk about what we're doing here. The long options are going to go up in implied volatility as time passes. We need to have a rough target about where that's going to be. That's going to drive the long strangle we build up in price. Problem with a long strangle, numerous problems with a long strangle, is theta erosion is terrible. It eats up a long strangle. Without a good volatility reason to take a trade, a long strangle by itself is a horrible trade. But we're going to fix that in a second. The second thing is it's an expensive trade. You spend a lot of money on it and your return on investment is pretty minimal unless you get a massive price movement. So that's going to go away. We want to shift this to be more of a volatility style trade. So let's shift it. To make those problems go away, we do something pretty simple. We use an option that expires before the earnings announcement and we sell it. So the theta erosion on the shorter term, short options, offsets the harmful theta erosion on the long options. Poof, that problem goes away. The credit we receive on the short options offsets the cost, the very high cost on the long options. Suddenly the trade gets much, much cheaper. So poof, that risk goes away. Now, in theory, as implied volatility goes up on options, the short options, it would hurt us. But since these options expire before the earnings announcement, we don't have much effect. It doesn't really do much. On the other hand, these long options, which are further in the future, they're more affected by a change in implied volatility. The effect is very radical in these. So we end up with a dual calendar trade. We've got a short put that expires in the near term, long put that expires after the earnings announcement. We've got a short call that expires before the earnings announcement, long call that expires after the earnings announcement. Altogether, there's two calendars, put a call calendar. Effectively, we call this a dual calendar trade. But it's a bit different because we're really using volatility to drive the profitability. So thinking this through, what does this mean for us trading? It means that we're going to be taking this trade between now and when the first option expires. In fact, we might even close it before that, but we're going to basically be building it out with the expectation that the entire trade, 100%, is closing before the earnings announcement itself. So we need to figure out between now and then what's a good range to put the trade. It's got 19.7% implied volatility, which gives us a market maker move number of about $60. All right, that is where we're going to start. We're always looking at this range based on when we expect to get out of the trade. The expiration the closest to when we expect is going to drive where we place our strikes. Because I don't care about what happens after the earnings announcement. It doesn't matter to me. I'm not even going to be in the trade. This one does. So current price is, okay, somewhere down here, 15.20. Now this is being based off of 19.7% implied volatility. That is a little bit higher than this. We're probably going to want to shave this down maybe $55, maybe even $50. We are currently trading at 15.22.64. Let's see what we've got. Let's shave off about somewhere between $55 and $57 here. Okay, 15.22 minus, I'm just going to say 57 roughly. 14.65. All right, that works. And we're going to add about 57. So 15.22 plus 57 is 15.79. Probably going to actually round that to 15.80. Now, this isn't perfect. This is more, horseshoes and hand grenades than darts. We don't have to get an exact number, but we want to get in the right range. This is going to help optimize the trade. If you make the strikes too wide, what happens is you have a trade that just can't win in the middle, and it ends up overall reducing your profitability too much. If the trade is too narrow, then the range over which the trade can win, you'll win a decent amount of money, but the range over which it can win is too narrow and it's too risky. So that's what we're trying to shoot for, is that sweet spot in this. In this case, it's roughly 1465 by 1580. So February 3rd, 1465-ish by 1580. There. Okay. We would be getting roughly, hold up, that's not right. Those both need to be short. Oh, come on. I hate it when I've got to fight, think, or swim on these things. There we go. $17.93 in credit. Ideally, if we stay between these 2 points, we actually get all of this back in our pocket as the credit as time erosion happens. Now, so that's part of the trade. We're going to jump out to the 17th, same strikes. Hopefully the same strikes. Yay, we do have them, good. 1465, long. 1580, long. Now, we've got $17, almost $18 worth of credit built into this, but we've got a $27 debit. This is going to be a fairly pricey trade. We can still scale this up and down. We'll scale this to the right size, and if you've got a small account, you can certainly scale this right down to 1 if you wanted. There's some advantages there. We are not going to take many contracts. We don't have much commission. Actually works out pretty well. That's a nice thing. Priceline trades pretty well too. There's a lot of activity. We should get fills on this one. Let's see if this trade makes sense. Let me take some of the questions. Sorry, I've been focusing on the trade. And yeah, Priceline earnings show 216 on CBOE. Here are the places, Bob, that I would trust, okay? I would flat out not trust CBOE. I would not trust Thinkorswim for earnings announcement dates. I would not trust a lot of the exchange sites, the CME, things like that, where you can also get some of these dates. The places that I do trust are here, just a handful of them, to be honest with you. I'd say the best one that, in my experience, has had the overall best track record of predicting when an earnings date is actually going to happen is by far Earnings Whispers. They actually do this as a process. By the way, the great information, horrible site. My goodness, somebody needs to talk to these guys and get them a web developer. They have a process that they use that analyzes a lot of information and comes up with a very, very good prediction of when the earnings announcement is going to be. And it is a prediction. We don't know until the company announces. And by the way, I'll talk about that in a second. These guys I trust the most. Coming in a fairly close second is Zacks. These guys also do a fairly decent job of figuring out the earnings date. Now, nobody is perfect, so please don't expect that there's a scientific perfect formula for nailing this every single time. You can see here, we've already got a discrepancy between Earnings Whisper, which is saying it's the 6th, and Zacks, which is saying the 15th. Okay, so you've got these two. These are my two go-to places for trying to find an earnings announcement number. The other one that I have had some decent luck with is Bloomberg. I'm not going to dig too far into finding that, but they seem to have decent ability to predict earnings announcements. They've also got a bad site. Blah, blah, blah. Okay, I'm not going to fight this, but number one place I go to is Earnings Whisper. Number two is Zacks. Now, once you have those, and I would flat out say never, ever, ever trust the date that you see in Thinkorswim. I don't know what their formula is. I don't know where they get this information, but if it's an unconfirmed earnings date, they are wildly wrong a lot of times. It's great to see it up on the chart, and once it's confirmed, they're usually pretty good. But do not trust Thinkorswim or your broker platform until they actually get a confirmed date. I'd go to those other two locations. Now, third test. What the heck does the market believe is going to be the date? And this is an interesting one, by the way, Bob, because this lines up far more with Zacks and the number you're seeing than the number I'm getting out of Earnings Whisper. And it actually is exactly why I changed the dates that I'm using. Just look at the implied volatilities. 17, 17, 19, 19, 20, boom, 24. Look for the big jump right there. As a matter of fact, the new spreadsheet I'm building on this actually shows you this jump. It's got a neat little chart on it, which will show you week by week what the implied volatilities are, and you can literally see right where the implied volatility jumps. This jump right here means that a number of people in the market believe that the earnings announcement is going to happen between this low volatility and this high volatility, between these two expirations. They're basically telling you what their opinion is. So that is probably one of the best alternative ways of figuring out the earnings date. I don't know what day between those, but I do know that the market believes that it's going to happen in that period. Now, it doesn't mean they're perfectly right, which means I'm still going to go with the 3rd of February by the 17th of February. But that gives you some ways of working that out. So does that make sense, Bob? Let's see here. A couple questions. Seems we're hoping to rise in IV in a week or two. Um, Joe, yeah, absolutely. And by the way, I'm not hoping for a rise. I'm actually going to show you how to predict the rise. This is not something that is a wishy-washy, let's hope something happens. This is something that consistently happens time after time after time. In fact, I'll stick my neck out and say this. Predicting this rise in implied volatility is a heck of a lot easier and a lot more consistent and a lot more right than picking a price of stock. I mean, picking the price of where stock is going to be is hard, very difficult. It's a wishy-washy, hopeful, let's maybe get it right type of endeavor. Picking out the implied volatility target, on the other hand, is actually pretty consistent and relatively easy to analyze and find out what's going to happen. That's one of the reasons I like this trade so much. If the trade is a good trade after we analyze it, you end up with a trade that you've got a lot of things you can trust in. You're not hoping, you're analyzing and making a decision. It's a big difference. You know, a bull put spread based on my belief that a stock is going to go up or a stock is going to go down for a bear call can have something like Mobileye had. Just shoots off in a different direction. Implied volatility is not going to radically go in the other direction. I'll promise you that much. It may not go to exactly the level we expect, but it will certainly head in the right direction. So that's what we're using. Okay, let's go and figure out the last little bits and see if this makes sense as a trade. Paul, first of all, I haven't decided whether or not we're doing the trade yet, but yes, possibly we would be trading it at roughly 27.17. That would be the price roughly that we're getting in at. That's a pretty expensive trade. It means that one of these positions is $2,700 worth of margin or cost. By the way, that's really just price line. You know, most of these is going to be much, much lower price. So for people with small accounts, you're not going to be filtered out of too many of these. But you should be able to trim this down to one contract in a moderately small account. Should be able to handle it without too much trouble. All right. Let's get the last pieces into play so we know what we're doing here. Robin, this is the process you were asking about before, so I will slow down. Sorry if I'm going really quick, but what I wanted to do is have the opportunity to get these in, and we've got a lot of things to do today. As you notice, we're covering a lot of information. Part of this is to prep and make sure that we're ready for the next 3-4 weeks. We're going to have these things coming at us fairly fast and furious. And so having some chances to do this, even if we don't nail down a perfect one today, is important so that we're ready to be taking advantage of these opportunities in the next month. Now, Robin, you were asking about the think back portion. Let me walk you through that. Whenever we're doing this, this is a very, very volatility specific trade. We need to answer a pretty important question. What is the volatility that we are likely to see on the options at a specific point in time? Roughly anyhow. We need to at least narrow down what's going on. So to do that, the first step is you put yourself in the place of the trade and you think about, what am I going to do when I close this trade out? Well, in this version of the trade, as opposed to the earnings trade, we're going to close the trade most likely on the Friday prior to the earnings announcement. We're going to be hopefully at a very low price buying to cover our short options, and we're going to be selling the long options. Now, the short options are going to be extremely close to expiration. They've got very little time value and almost no relationship to implied volatility at all. They're going to be pretty much all either intrinsic value or going towards zero. We might have to spend a few cents to get out of them, but not that much. So those are fairly irrelevant. On the other hand, the long options we're trading, the protective options that expire a week, or in this case 2 weeks later, we need those to stay as high of a price as possible. Now, those are getting strongly affected by implied volatility. So we need to know where implied volatility is going to go. We're starting at about 22, 23% on average, and it's going to go up to some level. We need to know that level to make sure that the trade makes sense. And that's the next piece we're going to do. So now that we know the thought, we're going to try to find the earnings announcement. And we are going to basically put ourselves in the position of that trade, but back in time. So I'm going to look for roughly where's the earnings announcement, go back to the Friday before that, and in this case, I'm going to look at the options that expire in about, well, either a week to 2 weeks out. I want to try to get a sense of where those implied volatilities are. So first step, find the earnings announcements in the past. And in this case, you can do this in a lot of places. Zacks even has a nice web page that has all of the historical earnings dates on it. I'm just going to use the chart on Thinkorswim. So I'm pointing at the earnings announcement, and this was on 11/7. And I'm going to go back again, 8/4. Another one, May 4th. And February 17th. And November 9th. I'm just trying to get some samples. Okay, I could even go back a bit more if I wanted, but probably won't. So 8/5. A couple things to think about when you're doing this. Is there any reason why any of these samples I'm about to take just wouldn't be normal? You know, is there something that was happening in the market that would just skew these and make the sample not represent what's likely to happen now? Right off the bat, I can say that this February sample is probably not going to be a good sample. You just don't want to pay much attention to it because, you know, look, it had a huge amount of implied volatility driven primarily by the fact that the market just corrected. All these other ones, though, are pretty decent. They're pretty normal. I'd say they're fine. So I'm going to the Analyze tab. I go to Think Back. Think Back allows me to go back in time and look at all of this stuff. If it reacts, come on. Come on. All right. So if my computer doesn't completely freeze, it's not frozen up there. Yeah, performance problem was detected. Big surprise there. God. By the way, this computer is a monster computer. There's no reason why Thinkorswim should have a performance problem on this. This is an absolute top of the line, most recent, you know, Intel i7 6700 chip with tons of speed, 32 gigs of RAM. There's no reason this should slow down. So don't give me that. All right, November 7th. Looking at the 7th. Now, we've got a little bit of fuzziness here. We're not entirely sure exactly where the earnings announcement's going to be, but I'm going to look at the 7th, the Friday before, and I'm going to look at two things. What's the implied volatility out 2 weeks, and what's the implied volatility out 1 week? Now, you'll see that the implied volatility 1 week is 55, and one out 2 weeks is about 44. Now, I'm just trying to get a range. I want to figure out roughly what's going on. Going back to August, and this is the 4th. And I need to go back to the Friday before that, which is July 29th. Now, the options that expire in 1 week are about 59. And in 2 weeks are about 45. See, now this is why this is good. We are getting a nice set of consistent targets. May 4th. Okay, go back to April 29th. Hey, lo and behold, let me see, 56 maybe? Hey, 58, okay. 58. And 45. So how would you like to be able to predict stock prices with this level of accuracy? This is nice and consistent. I love that. Probably going to skip February. Going to go back to November. And we're looking at November 9th, which means that I want the Friday before and 54%, roughly the same range. And 14 days out are 43. Okay, that gives me enough to work from. Does everybody, Robin especially, I know you were asking questions about this. Does everybody see the process? You understand the trade, you think it through, and you basically put yourself in the same position back in time. And you want to find out what the implied volatility was. Yeah, Lucas, yes, I would definitely characterize this computer as a beast. And, you know, this is my life. I put a lot of effort into this, and, you know, I'm not shy about buying good computer parts. I've actually got a really nice little setup here. I just added a 40-inch monitor, and I've got two 29-inch monitors to add to that off to the side. So I like my toy. Okay. We've got two possibilities, 55% or 44%, 59 or 45, 58, 45, 54, 43. I'm just going to test out both of these ideas and see if we're roughly in the right range. So now that we have some numbers to work from, let's see what happens. Now this is the key to the trade right here. You see this? We're now at about, let's say 23% on average on these two options. That is a huge, huge change in implied volatility between now and when we're going to be out of this trade. So let's try it the first way, which is, let's say that we're going to hit an average of about 45% implied volatility. So if this is 23% currently average, and we're heading to 45, that means we need to add, let's see, 22% implied volatility. And I'm just going to do this on the, let's see, February 17th options. 23%. Woohoo, there we go. Thank you. That is a nice trade. And that's what I'm looking for. I might trim off a little implied volatility. I think I overshot just slightly. Still doesn't matter too much. Okay, so we've sized this trade to be appropriate for our accounts. I'm not taking $27,000 worth of these things, but this right here is what we're looking for, and this is exactly why I like this trade. By the way, that wasn't even going to 57, 58%. That was just targeting 44, 45% as a possibility. The higher the implied volatility gets in these long options, the better this trade is going to work. And this one right here is set up nice. So we've got a great trade looking at this one. As a matter of fact, if we actually have this turn out right and we nail, and the earnings announcement happens at the right point, we could potentially be looking at hitting about 57, 58% implied volatility, which is another 12 percentage points past that. It's bringing it up to almost 33% increase, which is even higher. Okay, good. Thank you, because I really hated to get out of this class without a good trade in our hands. All right. This is exactly what we want to see. Let me walk you through what I'm seeing here and why this is, why this is good. I'm going to scale this back and set our expectations a little bit more rational. I'm even going to say that we're not even going for 22%. I'm just going to go for 20% rise in implied volatility. We have a trade that is set up right now is going to cost about $27,000. We're not taking that big of a trade. Don't worry. In fact, let's start out right now by resizing this trade. I've got a $100,000 portfolio. I want to risk about 2.5% on the risk of this trade. Each one of these trades is going to have a cost of $2,730. And if I put about a 40% stop loss, which is a very manageable stop loss on this, that means that each one of these could lose at the stop loss about $1,000. If I can do the math in my head on this one. If I want to risk a max of 2,500, I can only take 2 of these. This is a little bit big, but that's all right. I'll take 2. Now, what does this mean for me P&L wise? Well, first of all, I would be putting in about $5,400 to do this trade. Not an outrageously sized trade for my account, for the $100,000 account. Obviously, if you have a smaller account, you can scale down, take the single trade. As we do these, you're going to find that most of the trades are a little easier to scale. This one's a bit big. Sorry about that. But it's a really good example. So I'm going to be risking about 5,400 max. The reality is this ends up being a pretty manageable trade. This thing doesn't blow up. It fails over time. As we're in this trade, what's going to happen is at first, we're going to have some time erosion on our hands, and it's going to create a nice little rounded hump in the middle. And every day that passes, 2 things happen. Implied volatility increases towards this target, and theta erosion happens and causes us to move up in price towards this final P&L. As we get into the last week, what happens is the form of the curve changes from a hill to something a lot closer to this right here. And we start to get these humps. And what's interesting is in the middle, we could actually be making more early in the week than at the end of the week. If we're near the strikes, we'd be making more at the end of the week as the curve starts to fit into these peaks. We'd be making more at the end of the week than the beginning. So we have to think about that as we're managing this. Now, the nice thing is we're risking about $5,400, or costing us about $5,400 total. We have a potential for making even over that. This has a potential for making easily, let's be careful about the word easy. We've got a potential for making nearly 100% return. Great. That's outstanding. Let's see if it's safe enough to take. We've got lots of room to make money on this thing. Safe enough. The range that we need to stay between for our break-evens, this is just giving us a rough idea of where the trade's going to really start failing. It has nothing to do with the strikes. Well, it has little to do, but it's not really dependent on the strikes at all. Don't think of this as an iron condor. As long as we stay between about $1,400, roughly, and $1,660, we should actually walk out of this trade with some level of a profit. And that is a lot of room. So 1,400 by 1,660. All I'm doing is picking out the break-even points. 1,400. 1,660. Boom. All right, I'm going to kill that. Get rid of, actually we can use this. Let me edit that. The date that we're going to be exiting this trade is February 3rd. So 2-3. There. All right, let's zoom in on this so we can get a bit of a better picture. Okay, so as long as we're moderately comfortable, the price line is going to stay between these 2 lines, between now and honestly not even this date. We actually have good opportunities to exit this trade much earlier than this, but somewhere in this general range. We're talking about 3 weeks roughly, between 2 to 3 weeks. If we think we're going to stay within this range, then this is an excellent trade. It's a really, really, really solid, good profitability trade. Now, there's things that we can do to maximize our chance of being successful on this, but that means partially giving up some of our profits. But we've got a ton of profits to give up. We could easily do this. So right out of the gate, how do we feel in general about the trade? Lon, what was the plus vol parameter? Right now, I just am analyzing this based on 20% implied volatility increase, which is actually less than both of my possible estimates. So that was a very, very conservative addition. I expect to actually make more than that. Too good to be true? That's a good question, Juan, and you always want to ask that. I appreciate you asking that question. This is called the sniff test. Is it too good to be true? Is there something out there that I don't know about that is likely to make this trade go bad? Flip side of that is there an explanation of why this trade might be really good right now? Now, let's take it from both directions. First of all, I'm not sure about the gotcha. Is there a gotcha out there that could blow up in our face? Well, if there is, it's an unknown. I just do not know about it. If somebody digs something up, please let me know. I mean, if we've got something that could radically change the way this stock moves, tell me now and we can walk away. For the most part, I don't see anything. Doesn't mean it's not there. I just don't have a clue as to what it is. The second part, what could explain why this is so good? Now, this is digging into options a little bit. We're now up to like 300-400 level options. Part of it is that right now, today, let me double check this. Yeah. By the way, today is the perfect day. This is your birthday present for trading. One of the things that makes this trade effective is getting as much of a credit or return on the short options as possible relative to where the long options currently are. Now, let me talk about that. When implied volatility changes in the market, like on a big down move or pretty solid down move today, what happens is implied volatility of the shorter term options jumps up higher. And longer term options get a little extra implied volatility, but not as much. It takes more to move those. What's happening is because we're looking at this on a day when the market is dropping, it's giving us a little tiny bit of extra edge, actually not even a little tiny bit, probably a nice little extra edge as we sell our February 3rd options. It's not a ton, but I will certainly take it. And what happens is as you balance these two, the short options and the long options off against each other, we just happen to luck into a really great day to put this style of trade on. Because theoretically, if this stops, moving down fast, implied volatility on those short options will drop down, and we'll suddenly see a nice little chunk of some of our profit show up, because the short options are going to hand over their profit at that point. So that's one part of the explanation. The rest of it, I'm not sure. I don't think that this is outrageous. I've seen plenty of trades where we can make 100% return before. So that doesn't seem so far-fetched that I'm sitting here saying there's no way that this trade is real. But I am pretty happy at the general look. I mean, this is what I'm shooting for. This is what I want to find. And in general, I like it. Nice. So how should we group this? All right, first of all, it doesn't really matter too much. As long as you have all four legs in, it is the trade. The way that Thinkorswim categorizes this is a double diagonal, which I think is absolutely absurd because it doesn't even have one diagonal in it, let alone the double. Probably the most common way to do this or to call this trade is a dual calendar trade. Now, entering this trade, I like this trade, by the way. Anybody see some reason why we shouldn't take this? Any thoughts? Raise your hand, scream, stop, whatever. I do have an exit strategy. We'll walk through that step by step in just a second. Juan, if we have more down days and volatility creeps higher, how much would this hurt this trade? As long as volatility is creeping higher and not shooting higher, we should be in fine shape. What will happen is you'll get a little extra implied volatility in the shorter term options, which will hurt us a bit. But we'll also get some of that in the longer term, which will help us and help balance off the effect. Now, if the market goes into a big correction, we really need our hedges to take over and help protect us there. Remember, max loss we can take on this is about $5,400. We're going to be putting a stop loss in place or a plan to get out with less than about a $2,500 loss. So that should be fine there. We'll be able to control that. the trade will tend to fail in a very controllable way. It's not something that just suddenly out of the blue blows up on you. And by the way, we'll walk through the set of guidelines and rules for this trade in just a second. So the failure possibilities are this. The stock starts moving up very rapidly in the next few days or down very rapidly. Either one of those will put us into at least a short-term loss. Generally, as long as I'm between my strikes, I don't care. It doesn't matter to me. Now, on the other hand, if the stock moves fast enough and far enough that it goes past our strikes, then that puts me in a position where I'm worried it's going to keep going, and basically there's no amount of time erosion that's going to help us. We're going to be in a point of, increasing risk and increasing loss. I don't want to be there. Roughly, I would say that halfway between our strike, which is 1465, and our break even, which is 1400, is a trigger point for me that says if we hit this, I need to be thinking about exiting this trade because something is wrong. So I would basically put in a management point on this at about 1430. So that is our important point number one. On the top side, we're going to do roughly the same thing, halfway between about 1580 and 1661. So that would be 80, so about 1620 on the top side. Now, our major risk, by the way, even at these points, we wouldn't necessarily be losing unless we got to them very, very, very fast. As long as we've got a couple of, a week or two under us, if we hit this, we're fine. We're actually making money and we're doing good. We'd be exiting with a nice profit. If we go too quickly, we would be losing money. Now, between the two strikes, as I said, I don't care what's going on with the P&L. In fact, I'll even ignore my overall stop loss because mostly those are just little weird interim effects that go away pretty fast and I don't have to worry too much. The one thing that we can be concerned about is if Priceline decides to announce that they're doing an earnings announcement at some really, really crazy date, completely outside of our time frame. But this is 2 weeks, and we've got the highest probability of Priceline announcing during these 2 weeks. I think the risk is there, but it's relatively low. If we find out that they confirm their earnings date and it's past February 17th or before February 3rd, we basically just need to close the trade. And it will be a loss, but close the trade and walk away. Now, a couple other things that we have to pay attention to. As we're managing this trade, there's a couple of key points, and I wish I could show them to you, but Thinkorswim doesn't really let me do this very well. As we get into the final week of the trade, there's going to be this shift that happens. In fact, we could even see a nice profit coming higher than what we believe the end profit's going to be. If we're near the middle of this at that point in time, we are going to be paying close attention and looking to see whether the overall trade starts to have a positive or has a positive theta, which means it's gaining in value each day, or starts to have a negative theta. If it's in the middle, we're going to reach a point somewhere around Tuesday or Wednesday where the trade will start to have a negative theta. Now that means that we now suddenly have theta erosion moving against us, just in this tight little region in the middle. We close it out. And by the way, at that point, we're very, very happy because we've got an enormous profit. So I wouldn't worry too much about that. I would put the range between about probably 1490 and about 1550, just roughly. So if we happen to be between those 2 points, and we get to Monday, Tuesday of the last week, which would be basically the last week of January, we want to consider watching the theta erosion and making sure if it goes negative or close to zero, we close out. That'll get us our best profit. If we are closer to the strikes, basically this range here or this range here, well, that's wonderful. We just leave the trade in until close to Friday and we take an even bigger profit. Now, we have an alternative. What I just laid out was a game plan for managing the trade. And by the way, there'd be one other piece to that. If the trade drops in value to a 40% loss, that's the 0.6 times that. So drops in value to about, say, 1625 475. I would basically make that an eject point. We want to be closing out before it dropped in value anything more than that. That would basically limit our risk to less, actually about $2,000. Reasonable size risk for this. Now, ideally, we want to be managing it well before it ever gets to that point, but that would be another control point. Now, all of those points and all those ranges and things like that are one way of trading it. And if you want to try to maximize your profits, then they're certainly useful. You can use those as your game plan. On the other hand, if you want to simplify this, there's a very, very simple thing we can do. And that is, let's just put a nice, reasonable, easy to hit, but very good profit target on this and take our money and run. In this case, I would actually probably go for about a 50% profit. Is everybody reasonably happy with 50% over maybe 2 weeks? If somebody's not happy with that, please let me know. There is more potential in here. But if I do this, what happens is I could leave a limit order in with a profit target. In this case, I would be, let's see, 27.11. I'm going to add 8 cents to account for commissions, which really doesn't mean much in this, times 1.5. I'm just taking a portion of the profit out there. A decent portion, but just a portion. So if the price of this hits about, let's just round this to 40.75, I could leave a good to cancel order with a limit price on it of 40.75. If it hits that, I walk away with a 50% return over a couple of weeks. That right there, I've found in general is a nice, easy, simple way that you don't have to stress about, you don't have to make a ton of decisions on, that you can get a good profit. Now, we will win that way more often than we win the other way. But if we use the more advanced strategy to manage it, we have the potential of making more money, of nailing a higher profit. It's a trade-off you need to make your own decisions about. What's right for you? You want to put the time and effort in and shoot for the more money? Or do you want to put the profit target in that's good, solid, easy to hit, and basically exit the trade faster with a higher probability of success? Either way is fine. Just figure out what works for you. I'm going to lay out the rules, but I think that I really like the idea of putting in a limit order to exit this. What are you guys thinking? John, by the way, 60% is actually not is calculating the stop loss price, but understand what happened there. I was calculating a stop loss of 40% loss. That means that it would have been 60% of the price, and that's how I calculated that. Sorry if that looked confusing. So I basically just put in a 40% stop loss, which I could have figured out by multiplying the number times 0.4 and then subtracting that from the total, but I just cheated and multiplied by 0.6. So my stop loss point would be, or my eject point would be $16.25. My profit target point would be $40.75. And I think that's the approach I prefer to use on this. Nice, clean, simple to do without a whole lot of jumping through hoops. But do be aware there is a lot more potential in this trade, and you could work harder to make some more money and potentially make a fair amount extra. I'll put some notes in the recap that detail that, but we're going to approach it from the simple point. Is there a minimum volatility adjustment on this type of trade? Shane, this is how you determine if this trade is a good trade or not, and it's actually quite simple. You see this curve right here? If you have near the center of this curve a decent profit margin, and by the way, it doesn't have to be huge, but I'd like to see at least like a 10, 15%, maybe 20% profit margin in the middle of the trade, then normally that indicates it's a pretty darn good trade. That'll mean that overall you're going to have potential of making a considerably higher profit in some of these other areas. You'll have a nice wide range relative to the stock itself over which the trade can work, so it gives you plenty of wiggle room. And in general, that's my threshold for taking these. If I do all of these adjustments and I honestly look at the target implied volatility and it's not and the P&L chart comes out so that the bottom of this saddle is down close to zero, I don't take it. It's just not worth it. But in almost every case when it's higher, it is worth it. The one exception to that is if you ever have a situation where the stock is moving around really, really radically, shooting up, shooting down, then I would probably, not even take that trade. I just walk away. In fact, I probably wouldn't have gotten to this level of analysis. We put a lot of effort in today. I wouldn't have even bothered. So that is my criteria for saying yes or no to taking this. Now, obviously, you need to pay attention to the symbols, see if there's any other risks. Just look out for some gotchas. Just make sure that there's nothing too crazy going on. Boring is good. But if you hit that middle of the saddle, having about a 10 to 15, maybe 20% return, that's usually a good possibility. All right, any other questions? What other thoughts do we have? And have I missed anything? Bob, do I like this a lot better than a 1580 calendar, same dates, 1460? Well, this is what you would end up, let's see, 1580 calendar. Hold on. You mean just doing the 1580? If you do that, Bob, you can certainly do that. But what you're doing is you're changing the trade into a higher return trade, which is good. But it's very, very directional. You have to be very comfortable that price line is going to be heading up towards 1580. If it pulls back and goes against you, you're not going to have the put side to be an advantage. If it goes in your direction, you've actually got a much larger chance or a much larger return on investment, and you'd make a lot more. But it's going to be harder to win. In this case, I'm basically looking at price line as if it's, for the most part, drifting roughly sideways, at least over the time frame that I care about. I probably wouldn't do this as a directional trade. I just don't have enough confidence that it's going to go in a particular direction in the time that I need it to. Good idea, just I probably wouldn't do it this time. Okay. How can you follow the overall theta? Well, if you've got Thinkorswim, or actually almost any trading platform, you should be able to see it pretty clearly. Just look in your position measurement, and there actually should be a little box for theta. Hold on. I hate that Thinkorswim doesn't let you change the width of these columns. Here, I actually have a theta column for my trades, and you can actually roll down through it, and it tells you what the theta is. How much is the trade going to change in value between today and tomorrow? Negative basically means that it's eroding down. It's going against you. Positive means that it's in your favor. So when I'm looking at the beginning of the week, I'm looking to make sure that my theta stays moderately positive. As soon as it switches to negative, I know that I'm kind of at the peak of the profitability of that trade at the current price level of the stock. So you need to kind of think, do I think that the stock price is going to change? If you say yes, then you want to put that into your calculation. But for the most part, if I see things go negative on my theta, I would get out of the trade at that point. Now, and by the way, that only applies to the last week. Don't even consider that early. Do I think that this is an okay trade to sit on your hands? No, I don't. We have an opportunity right now to take it. This trade will not be the same trade in a week. Being passive on this trade is not a good idea. What happens is that every day that passes, that implied volatility goes in, and the opportunity you have gets narrower and narrower, and the profitability gets smaller and smaller. I actually think today is just about the ideal day to take this. This is really a good setup. It's better than I expected. I wouldn't wait too long. If you try to do this, we need the time. If you try to do this in the last week and a half, 2 weeks, it just won't work. So probably not a good thing to do. All right. Yeah, no problem. All right, I'm going to fire this off, and I'm going to wrap this up. We have had a really long day today. But everybody good on this? Everybody clear as to what we're doing, why we're doing it, how this all works? hit me with questions and I will answer them. But I want to make sure that people know what this trade is and why it works. Okay, I have placed an order right now at a 27.18 debit. Now, this is a very high-priced symbol. We could actually wiggle a lot on this. I would be happy to maybe shift the target price in this by even up to 50 cents. Percentage-wise, it's minimal. So there's lots of wiggle room up and down to get in on this. I'm going to leave this for a little bit at 27.18 and then hopefully get a fill. If not, I'm probably going to jump up to a bit higher. Actually here, I'll be a bit aggressive right now and just go to 27.35. But I would give this easily a good 50 cents wiggle room up or down. Hey, there we go. Instant fill. You don't have to be as aggressive as I was. It's better off if you get a bit better of a price. But really, considering this thing's 27 bucks, a couple of cents here and there is not that big a deal. All right. Any questions? Let's see. VXX positions. David, you get filled at 27.10. Bastard, you beat me. 27.20. Man, okay. Everyone's beating me here. See, I don't always get better prices than you, so don't think that. All right. I'm starting off in a worse position than you guys. You know, congratulations, you win. All right, what I'm going to do now, if there's no other final questions on this, and yeah, Juan, I want to nail a winner. This is good. I'm looking forward to this. If there's no other questions on this, I'm going to wrap up the session. I'm going to send out the alert right now so that everybody has this in their hands, and I'll send out a full trade report on this. And then for those people in the full throttle, I will see you tonight. And we're actually going to be exploring calendar trades tonight. So this is actually quite good. This fits in pretty neatly to the discussion we're going to have tonight. Any of you who have been in full throttle in the past, not necessarily signed up for this one, but remember, you're eligible to come. You're welcome to come to the session tonight. As long as you're still a member, you can come to any of the full throttles in the future. So I'd love to see some of you, and we can go over this style of a trade, at least the basic concepts, not everything. Next week on Tuesday night, we're actually going to get into volatility trades, which is this. This is exactly what we just did. And we'll be going into a really deep dive on the teaching of that. So next Tuesday, the full throttle class on volatility trades is going to be heavily focused on this style of trade. If you've got any questions, love to answer your questions then. Other than that, I think we had a good session. Appreciate it. Sorry for being 3 hours, but this was a big one. Lots of things to go over. Hopefully everybody enjoyed it, got something useful out of it, and I will see you all next week. I executed 2 contracts, Bill. It's a pretty, it's a pretty expensive trade. 27 bucks plus change to get in. That's $2,700 per position. I ended up putting on 2 contracts, and that was based on a $100,000 account. Now, I think there's a lot of wiggle room. Even to a much smaller account, you could still do one of these. But please be careful. If you don't want this trade to take up your whole account. In fact, I don't think you should have it take up, a really big, huge portion of your account. So if you do have a smaller account, I'd say that this time, like a real small account, this time it might make sense to hold off. I don't want you to expose yourself to too much risk on these things. These are going to be lots of opportunities coming up, and most of them, if we didn't have a $1,500 price symbol, it wouldn't be this expensive, and we'd be able to do a much more scalable trade. But I don't want to give up price line, just because of that issue. All right. No, Ray, the trade has not been sent out. I got to do that right away. So I got to wrap up and say goodbye. But I'll see everybody next week. I'll see the full throttle people tonight. And let's look forward to making some money. And, let's also, ideally, let's close out Whole Foods. By the way, this is the same style of trade right here. Whole Foods and we're really close to hitting our profit target right now. We're literally cents away. Good chance we might actually see that close this afternoon. If not today, maybe the next few days. All right, everybody. Good day. Thanks a lot. I will see you all later.